It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today.
Hey, good morning, everyone. Stock futures are under pressure to start the week, coming down from Friday's big rally on a strong jobs report that we'd seen. Now, Treasury yield spiking, the 10-year rebounding above 4%. Wall Street preparing for the kickoff to third quarter earnings season. The next test for the markets, with the S&P 500 up 20% so far this year.
And oil prices on the rise once again, adding to last week's 9% gain, the biggest weekly move higher in more than a year. Some investors are now growing a bit concerned that higher oil prices could actually reignite inflation here in the U.S. The rally coming as traders assess escalating tensions in the Middle East and fears of a wider spread war in the region. Today marks 1 year since Hamas launched an attack on Israel.
And a make or break moment for Tesla after a 2-month delay. CEO Elon Musk will reveal details about an autonomous taxi fleet that he's teased for years now. Musk said in June that the tech alone would boost the company's value by at least tenfold. The robotaxi event is scheduled for Thursday, October 10th. Shares of Tesla are flat on the year amid slowing demand for electric vehicles.
Futures under pressure after rallying Friday on that blowout jobs report. Treasury yields jumping on risk that economic growth and inflation will keep rates higher for longer. You're looking at the 10-year yield above that 4% level. Joining us now, we want to bring in Steve Sosnick. He's Interactive Brokers Chief Strategist. And Steve, it's great to kick off the week with you here on set. Let's talk about what's going on in the market, because we saw the massive rally on the heels of that better than expected jobs print on Friday. Now here we are today, and it looks like investors are almost second guessing maybe that initial reaction. I'm curious, do you see maybe some signs that the setup right now might not be as attractive for stocks?
Well, first of all, good morning, Shauna. Good to kick off the week with both of you. Let's put this morning's sell-off in perspective. We're giving back basically the last half hour of Friday. So, you know, these are the kind of days where I get a lot of questions, why are we down? But no one asked me on Friday afternoon why we're ripping higher mysteriously in the last hour of the day. So, putting that all in perspective, yes, we do need to rethink the narrative that we've been coming in with. The economy is, you know, forget soft landing. Maybe we're having no landing. That's what this jobs report may be telling us. Also, you know, I think we'd all sort of thought mission accomplished on the stable prices part of the dual mandate. And on top of it, you had monthly hourly earnings rise more than expected, 4.4%. So this is tough. This is tough if you're sitting around waiting for massive rate cuts. The market pretty much told you by 2-year yields zooming about 25 basis points higher that that's not coming. On the other hand, we should always be looking for a stronger economy, because that's really what drives stock prices.
And so with that in mind, I mean, essentially what you're telling us is when the markets rip higher, nobody's calling you to ask you questions, Steve. But I mean, at the end, you know, besides the jest there, it's really thinking about more largely here what this market is now kind of repricing as to where the Fed sits within whether they're behind the curve or not, which was the fear going into this most recent print.
Yeah, well, first of all, just to say the thing about people don't call, it's true. People don't call me. Markets are supposed to go up.
They're happy.
Yeah, exactly. I call it socially acceptable volatility. If you get a move up, that's the same degree as the move down. People like the move up because it happens. It's what they want. When it moves down, that jolts reality, and that's when people call me. But in terms of resetting the narrative, this is exactly what we have to do now. I think we got all through this process. You know, I wrote something before Jackson Hole and went back through my notes of stuff I'd written before. And 2 years ago, they were hoping for a Fed pivot, which, by the way, they didn't pivot. They kept raising rates right through that whole thing. So the markets have always been ahead of the Fed. We're like children with candy. We always want that sugar rush. We're not necessarily going to get it. We don't necessarily deserve it. And that's okay, because why? Let me put it on the flip side. You know, we hear about monetary policy being too restrictive. Based upon what? We have stocks at all-time highs. We have bond yields basically at multi-year lows, even after this pullback recently. We have credit spreads very tight, meaning that corporations could borrow money if they need to. You have all kinds of risky assets doing well, you know, Bitcoin, et cetera. Where exactly is the restrictive monetary policy coming in? And so I think that, you know, Powell, I think the 50 basis point cut in hindsight was more of a let's catch up to the fact that I kind of wanted to do this in July and they wouldn't play along with me. So let's do the 50. But he was very clear for the markets not to expect more than 25. And the market said, we don't care. We're going to price in 50 anyway. And so here we are.
But then if we don't get, because we had Peter Chur on the program after we got the jobs report on Friday, and he was saying he actually wouldn't be surprised if the Fed does take a break if they do reduce by another 25 basis points at the meeting in November. Maybe they aren't going to move in December. And I guess just given what you were saying, just market expectations versus what the Fed has done, if we in fact do see the Fed take a much more measured approach and maybe what the market is pricing in, how is that problematic? Or I guess how should investors be looking at that?
It's not problematic in the sense of if the economy delivers, it's not problematic. Think about where we were at the start of the year. We were expecting a soft landing and 7 or 8 rate cuts. Where are my 7 or 8 rate cuts? We're not getting them. They're mathematically essentially impossible at this point. But the stock market didn't care because the economy was good. Earnings delivered. To me, the much bigger question becomes what happens at the end of this week when earnings season starts and into the next coming weeks? Can the earnings that's being priced in get delivered? Can we get double-digit earnings growth, which is priced into stocks right now, while having an economy weak enough to justify massive rate cuts? I don't see that happening. And so if I have to pick one, I'm always going to pick the stronger economy.
You know, I was looking at some of the FactSet data from late last week, saying essentially that the estimated S&P 500 Q3 growth rate for earnings is 4.2%. That's the expectation. What is the theme that you think propels this earnings season?
It's all about guidance, Brad. That's really what it's going to be. We've seen this multiple times when stocks. It used to always be that if stock beat its DPS estimate, then that was a good reason to rally. That is no longer a sufficient condition. It's a necessary condition. You're not going to rally if you don't beat your published EPS. But in an era where 75 to 80% of companies beat their EPS estimates, does it really matter so much as all the other stuff? People are looking through it. And again, the 4.2% for Q3, but I'm talking, double digit when we go out, 4 quarters. Are companies going to basically be saying that the guidance that's priced into their stocks is adequate or sufficient or insufficient? And that, to me, is really going to be the key item to watch for, basically in almost every company that delivers earnings.
And Steve, as we step back and we head into earnings season, there's a list of things for investors to keep in mind at this point. But I think the argument, or one thing that investors continue to be a bit nervous about, are the lofty valuations and whether or not everything has to go exactly according to plan in order to keep some of this momentum alive. Are you at all nervous at all? Maybe nervous isn't the best word to use here, but do the lofty expectations or lofty valuations, make you second guess maybe some of that trading action that we could see here, at least in the short term?
Absolutely. Think about it. The best analogy I could give here is sort of like high jumping or pole vaulting. As we keep raising the bar, which is fine as long as we keep clearing it. But if you raise the bar high enough, eventually you won't clear it. And that's why I focus on the guidance aspect of it, because it's really about, is the economy going to be suitable for a wide range of companies to maximize their earnings in a way that investors are pricing in? When you have a 26 trailing PE, it's not a record high. We've been higher. We've been about 30, I think, in the late 90s. And actually in 2021, we were at 30 as well. But this is pretty lofty. And so you have to deliver. And again, if the companies can deliver, and a lot of that has been coming from the mega cap techs, both because of their weight in the index and their propensity to deliver solid earnings, can the rest of the 493 continue to deliver? And can we see that from the stock market as a whole?
All right. Quite the accomplished stock market pole vaulter yourself. Steve Sosnick, Interactive Brokers. Thank you so much for taking the time.
My pleasure, Russ. Thank you.
Ahead of the opening bell. Well, we're looking ahead to bank earnings out Friday, kicking off third quarter earnings season. You've got JP Morgan, you've got Wells Fargo, BlackRock, Bank of New York Mellon, BNY, and all of them set to report here. Joining us now, we've got Argus Research's Director of Financial Services Research, Stephen Bigger. Stephen, great to have you here with us this morning. So, of these banks that are essentially going to give us the forecast, the economic type of forecast and backdrop, at least in the purview of what they're seeing in engagements with their clients, how do you think that's going to set the tone for this earnings season?
Yes, good morning. I think, you're right. Banks usually do set that tone. And I think we're looking at an interest rate scenario here that is going to be beneficial for banks and beneficial for the market. So, it's odd that as bank analysts, we typically root for higher interest rates because that's better for net interest margins. But there has been a point where these high rates have kind of worn out their welcome. So, if we get some better, lower rates here, that will help stimulate some of the loan growth, which has been very, very weak. That will help take some of the pressure off deposit costs, which have also been elevated for banks, and then also kind of helps with the increasing the odds of a soft landing, and that will help with loss provision. So, that slower economy has produced higher unemployment here. To the extent we can take some of that pressure off, we get lower loss provision. So really a triple boom for the lending business if lower rates pan out.
But Stephen, what happens if the Fed does delay the rate cutting cycle just a bit? And I bring this up because, yes, financials are supposed to be, I guess, slightly lower than where they were a year ago as a group. But when you take a look at banks specifically, that subgroup expected to show a 12% drop from a year ago. So if we do see a further delay, maybe in some of those expected rate cuts, what does that setup then look like for these larger banks in the second half of the year?
Yes, well, so we have been counting on lower rates, and of course that is a double-edged sword and hurts on the net interest margin front. But to the extent that the banks are pretty well hedged here, the economy doesn't fall off a cliff. I think again the Fed has kind of navigated a path towards lower rates, or at least is there in case the employment situation gets a little worse. They'll lower rates some more. So I think banks are pretty well hedged, and they'll do okay. Loan growth has not turned negative. Loss provisions have not increased to the point that it's really hurting profitability at this stage. And then you've got the capital market side, which is showing some signs of rebound. So I think all told, the next 6 months probably better than the last 6 for banks.
And so with that in mind, the net interest margin bottoming process, we've heard that be discussed by many of your industry colleagues. Do you believe that that's finally seen a trough, and how will that be reflected in these reports that come across this week?
Yeah, well, as I mentioned, I think in particular it's the high deposit costs that have really been putting pressure on those margins. So to the extent that we already had the first rate decrease from the Fed, that's going to take some of that pressure off deposit costs, and net interest margins should begin to stabilize here and potentially move higher again as those deposit costs get a little more favorable for banks.
So, Stephen, what's your top pick then going into this earnings season?
Well, we still like JP Morgan. They are not the biggest beneficiary of lower rates. They've got a lot of close to $1 trillion of deposits that earn nothing. So they would benefit as rates went up, but won't benefit as much as when rates have moved back down. However, they've got terrific capital markets franchise. I think they typically are best in class. They're growing share there. So we expect good things out of JP Morgan. Certainly the favorite amongst the biggest banks. And then secondly, you've got Morgan Stanley, which I think is also again, because of the rebound in capital markets business and the wealth management franchise, which is about close to half their business. I think that does well too, given the rising values of stock prices and fixed income values. So that should benefit the wealth management side also.
All right, Stephen, always great to have you. Thanks so much for joining us here this morning.
Thank you.
Coming up on Morning Brief, activist investor Starboard taking a $1 billion stake in healthcare giant Pfizer as the company underperforms and investors seek a turnaround. Plus, we count you down to the opening bell on Wall Street as investors assess the Fed's next move and a possible no landing scenario. And pushing ahead to Tesla's robo-taxi event this week and why the EV company needs to show innovation to drive the company's share price higher. We'll have that and more coming up on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got Pfizer. The activist Starboard Value taking a $1 billion stake in the drug maker. Yahoo Finance's Anjali Kamlani has been all across this one. She joins us now with more on what this means for Pfizer. What does this mean then?
Well, let's take a step back and just note that this is a report right now. Pfizer has declined to comment and confirm any moves. And so, yes, $1 billion stake from this activist investor. We know that in the past, they have been involved in some healthcare deals, like they tried to break up the Celgene and Bristol-Myers Squibb move way back when. But what's really important to note about this move is that Pfizer has really been in the spotlight since the decline of COVID, but even before that. Back in 2019, in the pre-COVID era, a lot of eyes were on Pfizer to see what it was going to do with some of the same problems that it currently still faces, which includes a patent cliff for many of its blockbuster drugs, as well as how it will come out, and this is the new part, how it will come out of the pandemic era and those blow away revenues that we saw from the COVID products. We know for the vaccine, for example, a grand total of $86 billion over 3 years for full year reporting on sales there. Meanwhile, we know that since then, it's been quite a decline. We're looking at just mid to low single digits for the vaccine this year, plus Paxlovid will put it into maybe low double digits. So that's been a concern for investors. We know that Pfizer's CEO, Albert Bourla, has told us, we've been covering this for a few years, the stock hasn't moved. And so he's told us that he's done as much talking to investors as he can about where the company is going. The company has invested somewhere in the ballpark of $67 billion, and that's including that $43 billion acquisition of Seagen. So they have been making the moves or trying to indicate, to investors that they understand the patent cliff, they understand that their pipeline is in question. Bourla himself put his pension into the stock earlier this year, just bet his entire pension. And so the company has been making moves, but it clearly hasn't done enough to move the stock up. You can see on your screen, it's largely flat and has been so even during the pandemic era, when other companies we know saw blow away results in their stock. So that's been the concern. We'll see what the turnaround, sort of demands are from this activist investor. We don't know many details just yet. We just know that this is the context, this is the problem, and here's someone who wants to allegedly fix it. We do know that they've been in touch with former C-suite, including the just prior CEO to Albert Bourla. So we'll see what they have on tap.
Yeah, certainly. And Anja, I know that we've talked time and time again just about the underperformance of this name. And obviously, this has been a huge issue for investors, for analysts out there. I'm curious, though, we don't have many details just on what exactly Starboard is pushing for here. But in terms of the turnaround or what analysts would like to see happen, I mean, that's something that's going to take quite some time, too. So would it still require the street to be rather patient here for the next several quarters?
Absolutely. And that's been the thing the company has signaled for a while. Every quarter when they do meet and when they have had discussions with investors, we do see the notes that come out from the analysts, and they do regularly say, that this will take time. It's a long-term process. All these acquisitions that have been made for the products to then contribute to the pipeline based on the expected reduction from these products that are going to go off patent. All this is going to take time, and the company has indicated that investors have been listening. So it's just a question, I guess, of how quickly that turnaround can happen and what else maybe they can do, cost cutting and otherwise that they've already expected. They did raise their guidance for the year, it's important to note. So that's one interesting thing. But we do know, of course, COVID sales and the like are not going to be what they were in the past. So we'll have to see how it all balances out.
We will. All right, Anj, great stuff. Thanks so much for breaking that down for us. Let's switch gears and talk Amazon. Amazon getting a downgrade at Wells Fargo from equal weight to overweight, or from overweight to equal weight here, citing multiple headwinds weighing on Amazon's earnings growth and increasing competition from Walmart. Wells Fargo also lowering its price target to $183 a share from $225. You're looking at extended hours here with the stock off just about 1.3% head of the bell. Again, a downgrade here from Wells Fargo on Amazon, citing some of those headwinds here. Earnings growth, Walmart competition, simply saying that the cloud strength is not enough here. I want to zero in on the Walmart competition because that's really something that stuck out to me. within this note. We talk about time and time again how Amazon has very much been a leader or among the leaders within this space. And this analyst was pointing out that Walmart's entry here into the market changes the competitive field when they're talking about the fast delivery. They went on to say that cheaper fulfillment pricing than Amazon. Walmart can also match the shipping speeds that Amazon has. Walmart has constructed a national next generation fulfillment center network, providing that next day or 2-day shipping to 75% of the U.S. population. And I think that's one of the things, is speedy deliveries. I know personally speaking, it's something that has gotten me to be an Amazon user in the past and really favor over so many of those other larger retailers. So the fact that Walmart, and to no surprise, this is something that has been covered time and time again, obviously can match and maybe by some measures exceed even Amazon's offerings. Maybe that could be a real headwind, a real overhang for the stock going forward.
Yeah, I mean, for the fulfillment, hit the nail on the head. And then you think about AWS as part of this call, where they were talking about, as they're modeling out for the next few years here, they believe the market is more prepared for pressure on fourth quarter operating income. And then they caution that margin expansion could be capped into the first half of 2025 as well. Just to put some numbers on this as well, Wells Fargo has reduced its operating income estimates for Amazon by $5.4 billion, $4.5 billion, and $5.5 billion for 25, 26, and 2027 as well here. And so they're looking across where this is really going to kind of impact the business here, or where the business impacts is going to have a pass through to that operating margin and the income as well. And this is the number that people should be remembering, and the comp that they're going to be facing, because it gets a little bit tougher as they go on from here. The operating income margin growth here, the operating margin as of right now, they're expecting for that to be in 2024 coming in at about 68.3% growth here. That's compared to 200% growth that they had seen in 2023. And then you get into next year, that operating income year over year growth is expected to come in at about 24%. So significant deceleration there, even though they're still showing growth, not nearly what they've been showing for the 2 years past, this year included here. And that's what is really getting played into this call as of right now. Let's also go to the skies. Why not? Boeing and its striking factory workers are returning to the negotiating table today following a 2-week stalemate. More than 30,000 workers walked off the job in September, halting production of the company's aircrafts after rejecting a new labor contract. Now, each day of the strike costs Boeing an estimated $100 million in lost sales. As of right now, you're seeing Boeing shares flat just barely to the upside here ahead of the opening bell. This is, of course, just continuing to be the biggest headache and headwind that Boeing and the new CEO, Kelly Ortberg, is facing very early innings of the tenure there right now.
Yeah, certainly. And I think the question is how long, obviously the question is how long it's going to be until a deal is reached. But this has become very real. We talk about the fact that this is now the third week that we have had strikes, 33,000 striking workers here, so affecting thousands and thousands of workers. It is important to point out that last week workers did lose their access to company-backed healthcare benefits, each day costing the strike those millions of dollars that you just cited there, Brad. So there is a lot of pressure, I think, building up on both sides when you take into account the workers maybe now under a bit of stress here, or a bit of feeling a little bit more pressure in order to reach a deal because of the fact that they have lost their benefits. On the flip side, Boeing obviously under a lot of pressure given the fact that it is estimated $100 million in lost sales here for each day of the strike. But when you take into account that it doesn't seem like there has been much progress here up until now when these negotiations are restarting. So I don't really know how quickly they will be able to come to a resolution. It still might take a few days or weeks, for a matter of fact here. But again, I think the pressure is building on both sides, and maybe or maybe not, they will be able to come to some sort of agreement sooner rather than later.
And pressure building for some of the airline operators as well. I mean, it's already a tough environment right now for the airline operators that have talked to us as well. And we're going to hear from Delta later on this week, where they've already acknowledged that they've had to be doing more maintenance on the existing fleet that they do have while there is this backlog and they're anticipating taking delivery. But a lot of that had already been kind of estimated earlier on in this year, the delays in being able to receive those deliveries for the new aircraft and being able to insert them into the route schedule. And so as they push that out even further, as this continues to kind of play out for Boeing and the workers as well, No doubt that's going to have an impact more further down the line in the ability to deliver on some of those planes that are already ordered. And then it could impact Boeing on the additional expectations for the optionality that a lot of airline operators have in their contracts to be able to take on, if they so choose, additional aircraft at a later date as well. So several prongs to this at the end of the day.
All right, let's keep it right here on Yahoo Finance. We're counting down to the opening bell on Wall Street. That's happening in just over 2 minutes. You're looking at futures across the board on track to start the trading day in the red. We'll be right back.
And that's the opening bell on Wall Street and in Midtown Manhattan at the Nasdaq in today's game of Who Rang That Bell. You've got Oracle on the left side of your screen at the NYSE. ORCL is the ticker there. And then you've also got Sanofi ringing the opening bell at the Nasdaq. All right, we've officially kicked off this fresh trading week, and let's take a look at what the major averages are doing out of the gate here right now. The Dow Jones Industrial Average, you're seeing that lower by about 0.3%. I've got a 3-month chart up here for you here. We can kind of condense this just a little bit just to give you a look at what's taking place early innings in October so far here, trying to get solidly back in the green. Of course, there's been some volatility to begin this month here, but as we're taking a look at the Dow Jones Industrial Average to begin this day, we're down 0.3%. Nasdaq Composite, you're seeing that lower by about 0.25%. We'll round that off to past 5 days, lower by about 0.5%. And the S&P 500 about the same on a percentage basis over the past 5 days. Here today, out the gates, it's down by about 0.3%. We'll round that off too. Let's just take a brief look at a heat map here for you. 11 sectors in the S&P 500, more red than green right now. Energy leading the charge. The caboose, it's consumer discretionary right now. It's down by about 0.9%. So we'll continue to keep tabs on this. We've got even more heat maps for you, and for that, let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Thank you, Brad. I like that you're showing 5 days here. S&P 500 is negative for October. And let's remember, it was positive, and the major averages were all positive in September, which was supposed to be a negative month based on history. But now we're thinking, well, is October going to be that month? Was that demand pulled forward? Too early to tell here, but we still have stocks near record highs. S&P 500 now looks like it might snap a 4-day winning streak, but it is up 8 of the last 9 weeks just on this really nice tear here. I do want to show you what's happening with the 10-year because that is a little concerning. And you can see it's over 4% right now. Hasn't been at 4% basically since early August. And that was a little rally after this big drop here. So a rising yield combined with a rising dollar, which we're not seeing today, but we have historically over the last week, those combined can present headwinds for equities. So that's something that we want to keep track of. And looking at the sector actions, it looks like energy is still the only one in the green right now. And I wanted to show you something that's set up here. Here's a year-to-date chart. Now, this was a negative trend channel that it was caught in, just broke out as of, I believe, Thursday or Friday last week. But here, let me show you a max chart going back to the beginning of this century, the beginning of the millennium. 90 is a huge level, and it goes all the way up to almost 100. But so we're right up against these record highs. This is a massive consolidation. It could take a while to break out, but if it does, you got to think that there's going to be some momentum after being caught in this, 20-year base? So that's something to think about. Meanwhile, why is energy rising? That is because crude oil has been up, and also ExxonMobil. So let's take a look at crude oil real quickly. Here's the same 20-year chart. Not that dissimilar from XLE, but we want to check out the year-to-date. This is also breaking out of a small little trend channel and also rising off of a multi-year base. Here's a 2-year chart, and we see right there, a lot of room to run. You could go all the way up to the 90s and really not mean much technically. I promised Exxon, so let's take a look at the energy sector right now and see if I can pull that up. And here we go. Haven't checked out Exxon in a while, but it has been hitting record highs. In fact, this is the 4th record high of the year. So this is one stock in particular driving that outsized performance in XLE right now. Finally, want to hit on Bitcoin. I'm going to go back here. Bitcoin has still caught in a trend channel, speaking of trend channels, but we're going to take a look at it. It's on possibly the way up and away, but it just hasn't been able to find its footing just yet. That is a flag. I'll show you a 5-year chart here. This is a huge cup and kind of a little handle here, or at least a consolidation. This is another one of those long-term plays. If and when it breaks out, well, a lot of potential for higher prices, but we also know that Bitcoin is known for its false breakouts, so something to keep in mind. But the long-term, looking pretty bullish in a number of these assets.
All right, Jared, thanks so much for breaking some of those moves down here at the open. Escalating tensions in the Middle East, monetary easing, and China's stimulus are all potential catalysts for a return of inflation that could potentially change the narrative around Fed cuts that have been baked into the market psyche. Joining us now, proud to hedge around that risk, we want to bring in Kathy Rooney-Vera, the StoneX Chief Market Strategist. And Catherine, it's great to have you here. Let's just take a step back because I think investors have been looking at that massive run up that we saw in crude last week. It was up 9%, moving once again to the upside here this morning. And they're trying to figure out just how big of an inflation risk that is at this point. What do you think?
Well, any conflagration in the Middle East and any potential closure of supply routes of oil globally is effectively an inflation risk. But add to that Chinese stimuli. That's also an inflation risk. And with its upside to commodities, we've already seen that play out. And a way to hedge is by buying commodities. And the third thing is that we have global monetary policy easing, which should juice the industrial and manufacturing sectors globally. That, of course, as well adds to a growth story here in the U.S. that really doesn't seem to be following a slow landing or soft landing trajectory. So I think that ultimately inflation expectations do not correspond with the potential for a reacceleration in inflation, not the base case, but certainly something that, in my opinion, and what I'm advising our institutional clients is to protect your positions, protect your interest rate sensitive sectors such as tech with the purchase of put options while those options are cheap, while volatility is low, and it's cheap to protect yourself.
And how would you be playing on the other end of that, industrials and manufacturing, as you were just mentioning a moment ago?
Yeah, well, industrials and manufacturing are likely to see an uptick from contraction to expansion if we avoid a recession here in the United States, which is ultimately my base case scenario. So as we're seeing, we still see manufacturing in contractionary territory, but given the monetary easing and the beginning therein of this easing cycle, I do suspect we're going to crack expansionary territory over the next 12 months, of course, absent a recession here in the U.S. But my positioning recommendation information is a barbell strategy, and this has worked out beautifully for us. So coming into 2024, utilities was my top pick in terms of the S&P, and that was way out of consensus because this was the most battered and most unloved sector, not sexy, kind of defensive historically, but that was our top pick, and it's done very, very well, up 30% year to date. So I think that has played out well. And I think going into 2025, there are some inherent risks that are underappreciated and underpriced in risk positions right now.
Catherine, since you just mentioned utilities, given the massive run-up that we have seen, and congratulations on that call that you did get correct, is there still room to move to the upside, or should investors be looking to take some profits there, given that massive run-up?
I think it's over. I think it's done. The trade has played out just as expected with that 30% appreciation in price. And I'm actually going to publish a piece this week talking about this precise trade. I think it's time to realize those gains and to rotate into the next underloved, underperforming sector, which is also defensive. It doesn't have the same attractive properties as utilities, but I think healthcare could be one of the sectors that does well in 2025, especially if we do get some accumulation and some erupting of these underappreciated and underpriced risk, not only just on the geopolitical side, but also on the economic and political side.
You know, Catherine, you'd mentioned the puts a moment ago within technology there. You know, does that mean that the AI trade has already kind of started to show that it's going to be decelerating here, or at least that there's some rotation in the broadening out effort that you would expect to come forward?
The AI trade, I think, has reached a mature stage. So I think the market's going to be more discerning and not just, corporations say the buzzword AI and in their earnings calls and their guidance, and their stock surges because of using the buzzword. So I think we're in a mature phase, and I'm looking for second derivative plays. And that's part of the reason, Brad, why I recommended utilities. But I also like industrial real estate, because this is a second derivative trade on AI that can benefit from its ongoing development, because ultimately artificial intelligence is going to improve productivity. We haven't seen the full manifestation of that, of its utility. I think a lot is baked into prices. But as I said, I think it's going to be pretty mature and stable and trade in a stable range. There could be some more upside, but I do love playing second derivative trades on the AI perspective, as well as diversifying into underloved sectors, because the truth is AI really does improve productivity and efficiencies, lifting many boats. So why not broaden out our exposure to other sectors?
Catherine, how are you looking at the move higher that we've seen in yields, especially on the back of that strong jobs print? Now we have the 10-year yield right above that 4% level. Is that going to act as a headwind, do you think, for equities, or what is your read at this point?
It should, right? Because that takes away a bit of the equity risk premium from equities. And I think it's also correctly repricing Fed cuts. They're likely not going to be as aggressive as the market had previously anticipated. And if the economy does effectively avoid recession, which it seems poised to do, with the U.S. consumer being so robust and jobs, while companies are hiring less, not engaging in mass layoffs, that to me says that that the Fed is not going to slash rates. There's no need to do so. In fact, if they were to cut rates aggressively, I'm talking 200, 300 basis points, it would probably be counterproductive and bring inflation back, causing this whipsaw effect in monetary policy that nobody wants or loves. So that would take a hit to credibility. So the bottom line here is I think that, markets are repricing Fed cuts. Markets are repricing the possibility of inflation not hitting that 2% target anytime soon, or anywhere near that. And I think the Fed probably cuts maybe one more time this year, but next year I think probably cuts less than the market is currently anticipating. And that's what's happening right now in the markets, and they're internalizing that likelihood.
Catherine Rooney-Vera of StoneX, thanks so much for taking the time here with us this morning, just after the opening bell. And our viewers can stay tuned as well. You can check out a deeper conversation with Catherine. Be sure to check out Opening Bid with Yahoo Finance Executive Editor Brian Sozzi. Catherine, thanks so much.
My pleasure.
Goldman Sachs betting and getting more bullish on equities here. The firm raising its year-end target and its 12-month price target for the S&P 500. For more, we've got Catalyst co-anchor Madison Mills. Hey, Maddie.
Hey, Brad. So let's talk about Goldman getting a bit more bullish on the S&P 500 here, lifting their year-end price target for the S&P to 6,000. Now, 12 months from now, they expect the S&P to hit 6,300. I just want to take a look at the end of this chart here, right? You can see the lows for their price target in 2023 here on the board behind me. But then you also can see this price target kind of leveling off as we get near the end of 2024 and heading into 2025. So seeing more upside, but not as much of kind of a hockey stick run for the S&P 500 moving forward here. And I want to talk about what they are attributing this growth to within the individual sectors that are going to be reporting earnings over the next couple of months here as we get into third quarter earnings season here. They expect the highest amount of growth to come from info technology. That's going to be 17% of the upside in EPS growth for the S&P. Also expecting growth in comm services and healthcare. Now, a big percentage of the growth in infotech, about 20% of that is just going to come from the semiconductor names. So certainly a lot of bullishness from Goldman in the S&P 500, specifically as it relates to chips and the AI story. Not a big surprise given everything that we heard about them at their tech conference this year. Lastly, I just want to note, though, that the majority of their call on the S&P hitting 6,000 by year end is rooted in their call about GDP and the growth of this economy. They said that about 50% of the call is related specifically to the global economy, and that could also be the biggest risk to upside growth moving forward. It makes sense that we're getting this lift to their price target, given that they also decreased their recession probability odds down to 15% from 20% for the rest of the year, given that the macro picture is highly indicative of where the S&P will go, according to Goldman here.
All right, Maddie, thanks so much for breaking it down. I know you and I will be discussing that recession call, the adjustment of the recession call coming up next hour. Also coming up next, Tesla's big event is raising some eyebrows. Skeptics are cautioning that robotaxis may be years away from becoming a profitable venture. We'll discuss what this means for Elon Musk and shareholders. Plus, a programming note, are you on the hunt for the hottest market commentary? You are going to want to watch Opening Bid with Yahoo Finance's executive editor, Brian Sazi. He will give you unrivaled insights from top analysts and direct lines to the biggest power brokers in business. Tune in every Monday, Wednesday, and Friday at 8:30 a.m. Eastern Time. We'll be right back.
It's a big week for Elon Musk. Tesla is hosting its long-awaited robotaxi event on Thursday. The build-up to the event has sent shares of the EV maker higher in recent weeks, following a general slowdown in EV demand seen earlier this year. Joining us now with his insights, we've got Ron Yevsikov, who is the Director of Automotive Equity Research at Guggenheim Securities. Ron, great to have you on here with us. So are you expecting a boom or bust when they make these announcements this week?
Yeah, I don't know if it's that binary, but we do expect it's more likely to be a sell the news event. I think there's been a lot of hype into this event. We've seen the stock move up. Investor expectations are quite high in terms of the promises that are going to be made at this event and the products that are going to be shown. So I think ultimately there are a lot of boxes that have to be checked, and we think that a real credible path to robo-taxi commercialization in the next 12 to 24 months is extremely unlikely to come out of this event.
Ron, when you take into account how much has already been built into the price that we're seeing today, you mentioned so much of that hype. You mentioned the fact that investors have really been bidding this name up before the announcement. I'm curious, what do you think will be enough to trigger that sell-off? And you've got a price target of 153. I guess to what degree, or what is it going to be that really shifts investor sentiment to get us lower to that price?
Yeah, it's a good question, and one we're asked quite a bit. I think it's tough to have one catalyst that triggers, I think, our view towards the stock returning closer to what we think is fundamental value. But I would say that a business trading at 100 times earnings, 100 times our next year's earnings, with little to no free cash flow, it is really difficult to underwrite without the robo-taxi. So I think post this event, you do get a return to focusing on the fundamentals of the business, which remain quite poor. We estimate U.S. sales were down about 5% in the third quarter versus the second quarter. And while China growth was quite material in the third quarter, I guess we will see the quality of that growth once they report 3Q earnings with the gross margin line item. But it's tough to have any single catalyst from this point. But ultimately, even comparing Tesla to the other Mag 7 stocks, the free cash flow disparity is enormous, and the free cash flow yield disparity. So it's a really tough stock, I think, to underwrite fundamentally.
Ron, if we continue to see more consumer pressure right now, and especially as it translates through to auto purchases and the mindset there, what do you think that translates through for Tesla in the margins that investors have come to expect, especially even if they're adding on certain packages to their automotive experience? And what does this company need to do to ultimately generate demand for some of those more premium offerings?
Yeah, I think, for lack of a better term, I think the premium offerings are almost X growth at this point for Tesla. We've seen the Cybertruck grow, but it's largely been a function of cannibalizing Model S and X sales. If we just look at Tesla's sales volumes for premium vehicles, I think to see the gross margin inflection in the next 6 to 12 months is pretty unlikely. And I think it's important to know where we're coming from. Margins were 30% if we rewind the clock 2 years ago, gross margins. Today, we're sitting around 15%. So even if we marginally inflect higher, this is still a stock trading close to 100 times earnings. I think you need a material step function change, and there's nothing in the demand outlook that would support such a step function improvement in demand.
All right, Ron, I want to switch gears here and talk about Lucid. It's a stock that's trending here this morning. We got their quarterly production figures falling, missing expectations, and we're seeing this move lower in the stock price despite the fact, actually it's up higher now, up just about 2%. Maybe some of that has to do with the fact that deliveries did exceed expectations. I'm curious, Ron, what your view is of Lucid at this point, given the fact that we're still trading just above $3 a share. What is it going to take in order to really see that catalyst here to the upside?
Yeah, I think Lucid has some catalyst on the horizon in terms of the Gravity launch, which does unlock some TAM, but we've seen that the high-end electric SUV market is not as big as I think investors would have expected a few years ago. We've seen Rivian's sales kind of stall out here, as well as Tesla's Model S and X sales. So I think that until we get to the mass market car, which for Lucid is 2026 and beyond, it's kind of, there is a lack of catalyst to really drive growth and see that step function change improvement in unit economics and profitability, which is tough for investors to underwrite. We've seen the same pressure on Rivian, which we're buy rated on. Just that this view that until 2026, there's no real catalyst to change EV demand if you don't have a mass market product.
For Rivian, it seemed like there was a manufacturing issue that they were needing to work through. For Lucid, is there any more clarity that investors are getting about how much they're outputting and their manufacturing practices in order to ramp up towards that mass market vehicle eventually once we hit 2026?
Yeah, Rivian did have a manufacturing issue, but ultimately we think kind of all EV makers at this point are demand constrained, not supply constrained. Rivian did have some shortages on the commercial van and their enduro motors for the R1S and R1T, but even without those, EV makers are largely demand constrained at these levels. So I think that we don't really see a catalyst for a step function change improvement in demand over the next 12 to 18 months. I mean, people have made a case about interest rates. Historically, interest rates don't really have a major impact on new vehicle sales. Maybe it's different for electric vehicle buyers because demographics, they do skew materially younger. So you can think of a cohort that probably has less equity to put in the car or less down payment equity. But otherwise, it's really tough to see a demand shift in EV adoption in the next 12 to 18 months. Long term, we're super bullish on the space, but I think it's still a challenging 12 to 18 months here.
All right, Ron Yevsikov, thanks so much for joining us here this morning, Director of Automotive Equity Research at Guggenheim Securities. Thanks, Ron.
Thanks.
Coming up, we're breaking down Yahoo Finance's trending tickers. That's coming up right after the break. Stick with us.
We're taking a closer look at Yahoo Finance's trending tickers. We've got Arcadium Lithium, Micron, and Netflix, an unlikely neighborhood here, but we're doing it in 30 seconds each. Let's go. Arcadium Lithium, the stock surging right now. The global miner Rio Tinto is in talks to buy the lithium producer. Both companies confirming this today. Shares of Arcadium Lithium up 42% on the back of this news. And of course, many people will perhaps remember that this is a new company on the stock market, began trading early this year, January, and ultimately we've been tracking the shares in reaction to this move here. They said that they're looking to reach this potential acquisition. We haven't heard on a price or terms just yet, though, but we will see once an official announcement comes across.
We will see. All right, let's move on to the chip space and talk Micron. Micron shares on the move this morning. The chipmaker CEO and president planning to sell shares worth up to $20 million. In a filing with the SEC, Micron disclosing the sale would consist of up to 200,000 shares beginning the first week of November at the earliest. We're seeing a slight move to the downside here, off just about 1%. Not necessarily surprised given the fact that maybe this could be viewed as not so much a vote of confidence and maybe questions for Micron going forward. If that should be the case, I'm not necessarily sure. We've seen a massive run up in the stock, especially on the heels of its most recent very, very strong earnings print. So it's safe to say a lot of people are still excited about the path forward for Micron. Sean.
Yeah. And Netflix shares. Are you still watching? Well, Piper Sandler, they've upgraded the streaming giant to overweight from neutral and hiking their price target. The firm bullish on Netflix's ad-free tier, saying it has room for pricing adjustments. Meanwhile, not still watching, Netflix has been downgraded to a sell equivalent at Barclays. I mean, they're still going to be watching it, just less bullish, essentially, at the end of the day. But what Barclays had to say on this, with the backdrop here, their present valuation seems out of sync with its probable growth path. That from Barclays. Piper Sandler, a little bit more bullish. We mentioned why.
All right, coming up, tensions flaring in the Middle East a year after Hamas attacked Israel. We will discuss the potential risks ahead next on Catalysts. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day. We've got three catalysts to keep your eye on here at the start of third quarter earnings season, rising oil prices, and Goldman Sachs out with a list of its top stock picks.
U.S. stocks kicking off the week to the downside as markets brace for another key test, the start of third quarter earnings season. Now, investors are weighing the possibility of a potential no landing scenario, and this comes as the Federal Reserve is grappling with a stronger economy and a potential return of price pressures. We're going to discuss what that means for your portfolio next.
Plus, oil prices up again today amid Hamas firing rockets at Tel Aviv this morning. Investors are waiting for Israel's potential response as President Biden urges Israel to consider alternatives to hitting Iran's oil fields. We'll speak to a foreign policy expert about the risks ahead.
And we tap into some of the top-rated stocks on the street, according to Goldman Sachs. We'll dive into which names are best positioned according to the firm's conviction list later this hour.
All right, well, exactly 1 year since Hamas attacked Israel, tensions are escalating with no sign of ending. Hamas firing rockets at Tel Aviv this morning as the IDF strikes Gaza. Now, Israel and Hezbollah in Lebanon going head-to-head throughout the weekend. Meanwhile, the region is bracing for Israel's response against Iran, which could include targeting the country's oil refineries. Oil prices are rising this morning after notching their biggest weekly increase in more than a year. And Maddie, when we take into account the massive rise that we've seen in oil prices here, up just around 1.6% here this morning, up another up above $75 a barrel. Many people or many investors are trying to figure out just what exactly that move to the upside could potentially look like. But let's first get over to Ines Frey, has a closer look at this move to the upside. Ines.
Yeah, that's right, Shauna. And I just want to show you one of our charts where you can see WTI up more than 1.5%, Brent crude up more than 1%, but also the options market, the call skew really going higher. Its highest since March of 2022. That's when Russia invaded Ukraine. And so you're seeing that traders are very bullish. Now, remember that before this escalation between Israel and Iran, you had the markets basically in a bearish kind of tone, but you have seen this spike yet last week, oil up more than 9%. Let's show you the interactive chart so we can take a better look at where we're at. Well, you're seeing Brent crude above just around $79, WTI up above $75 per barrel. And you can tell that traders here are seeing that you're looking at oil that could be just above $80 per barrel. In fact, some saying that if you are going to see an escalation, that retaliation from Israel against Iran, interrupting Iran's supply, well, you could see oil spiking above 80, guys.
All right, Inez, thank you so much for joining us. We really appreciate it.
Thank you.
And joining us now for a deeper dive into the escalating tensions in the Middle East, we've got Michael Froman. He is the president of the Council on Foreign Relations and former U.S. Trade Representative under President Barack Obama. Michael, it's great to have you in studio.
Thanks for having me.
Coming in. So I want to start on the breaking news from this morning out of the region, as we've been discussing so far. Biden urging Israel to not hit any energy infrastructure in the region. If you were still part of the White House in this administration, what would you be advising the president to do?
Well, I think they understand that Israel feels the need to retaliate. And so there are three categories. They can go after military targets, as they did last time. They go after economic targets like the oil fields, or they can go after the nuclear program of Iran. Very much everyone's trying to discourage them from going after the nuclear program. I think Israel is trying to weigh which is the most effective deterrent for future Iranian activity. Right now, Hezbollah has been Iran's what we call second strike capability, that they always felt that if Israel were to attack Iran, they could use Hezbollah to attack Israel. But Hezbollah has now been significantly degraded by Israel in terms of killing off most of its leadership and degrading a lot of its military capabilities. So Iran is trying to figure out how to deter further Israel activity if they don't have Hezbollah to rely on.
Is there any way to deter really further escalation within the region, given the fact that neither side or any of the sides don't seem to be backing down at this point?
I think at each step, there's efforts to try and convince both sides to escalate in as proportional a way as possible, so to minimize the escalation. But as you said, at each step, it seems to be going further and further. Remember, it was about a week ago that Iran sent 200 ballistic missiles to Israel, not just drones, but these are missiles that can get there in 15 minutes. They were largely a failure, and I think that was to some surprise for Iran. Now the question is, what else do they have left that they can really attack Israel with?
Well, what could happen here if it escalates, not just between Israel and Iran, but also more broadly in the region? What if we see impacts to the Red Sea, the Strait of Hormuz, specifically with regards to energy prices, too?
Well, already we've seen the U.S. directly engage. Our CENTCOM forces have attacked the Houthis over the last week or so. The Houthis were the ones sort of trying to interrupt trade in the Red Sea. On oil prices, yes, they're up about 10% this week, but we have to remember they're under $80 a barrel, which is pretty modest considering all the tensions in the Middle East. When Russia went into Ukraine, it was a much higher spike in oil prices than what we're seeing right now. So there probably still is some room on the upside, particularly if Israel attacks Iranian oil capabilities. But there's a lot of excess capacity in Saudi Arabia, in the United States, and elsewhere. And demand for oil is down, particularly given China's slowdown.
Just given the importance, though, of Strait of Hormuz, that maybe it isn't too likely, or I guess the question for you is, how likely is it that we could potentially see a blockage of the Strait of Hormuz, just given the fact that I believe 30% of the oil flows through that region, so it could have severe ramifications for the price of crude?
If Iran were to retaliate by closing the Strait of Hormuz to prevent both its oil and the oil of its neighbors from getting out, that could have a significant impact. It's not particularly in their interest to do so, but it could have a significant impact. Iran itself is only about 4 million barrels a day out of a global market of about 100. And so there's already more excess capacity just waiting to be put on the market in Saudi Arabia than that 4 million barrels.
We're also getting closer to the election, of course, and we are at the one-year anniversary of October 7th, the attack led by Hamas. I'm curious, from your perspective, what should voters know about the single biggest difference between the two candidates that we have the choice of, and how they would handle this conflict that certainly is not going away anytime soon?
I think with regard to the Middle East, there's actually a fair degree of continuity between the two. President Trump started the Abraham Accords of bringing moderate Arab states into relations with Israel, and the Biden administration tried to continue that with Saudi Arabia. Both are going to stand firmly in support of Israel and its security, and making sure that it has what it needs to achieve that. And both want to minimize, I think the Democratic candidate has been probably more vocal in focusing on the humanitarian crisis in Gaza, the plight of the Palestinians, and the importance of a path towards a two-state solution.
Do you see that at all affecting funding for Israel then, if Harris were to be elected?
I think the United States is likely to stand very firmly behind Israel. There's some conversations in Congress about conditioning some of the aid on whether it's used in Gaza, some of the large munitions. But I think as a general matter, the U.S. stands firmly behind Israel's security.
What do you think is the biggest issue on foreign affairs that the next president is going to inherit?
Well, the world's a very messy place. I mean, clearly, it's a much more complicated environment to operate in than it's been for the last 80 years. And so I think the next president's going to have to figure out how do we assert U.S. leadership, have as much influence as possible, while making sure we're addressing the concerns at home. And I think either president's going to have to deal with those sets of issues.
All right, Michael Froman, thanks so much for joining us here in studio. Council on Foreign Relations President, thanks so much. Vice President Kamala Harris is on a media blitz with just under a month until Election Day. The popular podcast Call Her Daddy airing an interview with Harris on Sunday. She and her running mate, Governor Tim Walz, will appear in a 60 Minutes election special tonight. On Tuesday, Harris will make the rounds on The View and Howard Stern. So also appearing on The Late Show with Stephen Colbert. Former President Donald Trump was also supposed to appear in the 60 Minutes special, but he pulled out. And of course, the question is, I guess, why? He has been giving a number of interviews, especially when you compare it to what Harris has been doing. But Maddie, I think the real question is going to be the messaging from the Harris campaign. I think many voters are still familiarizing themselves with Harris, with her vision and what she has laid out and what she hasn't laid out for going forward into Election Day. And I think the question is getting that message out, because as we have seen poll after poll in the swing states showing Harris and Trump really almost 50-50 at this point, and the election very, very close. So it is critical to really appeal to those swing states and able to get those voters on board. I think the question is, what ultimately will do that and what she needs to focus on in order to win over some of that support. And on the flip side, what Trump needs to focus on in his interviews going forward in order to gain any sort of advantage.
And that is part of the reason that maybe she did choose to go on a Call Her Daddy. It has a very strong audience of Gen Z women in particular, a key voting bloc for her. We did get a clip from 60 Minutes from CBS, released a teaser of what we can expect from that interview. The full thing is going to come out, of course, later today, but really pressing her on how she would handle the deficit and how she would fund some of the policies that she has put forward, things like housing stimulus for small businesses. And she talked about this idea of getting Congress on board with taxing the ultra wealthy. She was pressed on the idea that this is, quote, the real world, and it's difficult to make that happen in Congress. She says in closed door conversations, she is hearing more political will for increasing those taxes on the highest paid members of the country. So it'll be interesting to get more detail on that and how the deficit is going to play into her broader policy initiatives moving forward as well.
All right, we'll keep it right here on Yahoo Finance. We've got much more of your market action ahead. You're watching Catalyst.
Investors are looking ahead to third quarter earnings season as the next big test for markets, with the big banks officially kicking off earnings cycle in earnest this Friday. Joining us now with more, we've got Yahoo Finance's markets reporter Josh Schaefer. So Josh, it's not just earnings cycle kicking off this week. We've also got the inflation data. We've also got a lot of geopolitical tensions that continue to unravel here. What do you think is going to be the biggest focus of the week for investors?
Yeah, Maddie, you make an interesting point there, right? Because I think one could probably argue that at least not until Friday it won't be earnings, right? Because we have some earnings leading into big banks, but really it's not until Friday, and you have that CPI print. I think if you have big moves on that, and then the geopolitical tensions, your guess is as good as mine as far as what's going to happen there and how that could drive markets. But to sort of bring that and get into earnings, it was an interesting point that Deutsche Bank's Binky Chadha made about sort of the environment we're in right now. He said he thinks the S&P 500 might not have as positive a reaction to earnings season this quarter because of all the other things we're talking about. When you look historically during an election year, this quarter doesn't move the S&P 500 as much because people are thinking about that election. They're thinking about the growing tensions in the Middle East. They're thinking about maybe the macro narrative here. So perhaps we're going to have earnings come and go without large moves. That's also because when you look at earnings for the quarter, the S&P 500 is expected to grow earnings year over year by 4.7%. It's solid. We're not looking at earnings going down, but quite frankly, that's not that remarkable of a number. And so that doesn't really pop off the page to me. Another key theme that I think will be interesting to see if we get here, guys, is sort of that broadening theme, right? So also, Akshata highlighting this in his note, talking about the fact that they're expecting a wide range of companies to beat expectations, a wide range of sectors, I should say. So what you're looking at here, light blue is your historical median. If the purple bar is going above light blue, that means it's going to be better than it normally is. So that gets you industrial cyclicals, consumer cyclicals, financials, all materials, all expected to be slightly better than normal. Notably, mega cap tech not in that group there, but I think that's going to be interesting to see is do we get confirmation of the broadening of this rally in terms of actual earnings growth? Are the fundamentals really there?
Yeah, and I also wonder just how much of the conversation could potentially change or is likely to change just following Friday's jobs report, right? Just in terms of what it means for the Fed, what that means maybe on the flip side, maybe it could be a bit more positive for consumer staples or even consumer discretionary names when you talk about the fact that maybe consumer will prove to be a bit more resilient. So also factoring that in, I think is going to be interesting here as we get into earnings season.
And what do companies say about that cutting cycle, right? That was something that Osung Kwong at Bank of America highlighted to you and I last week, Maddie, is what do we hear companies say about, okay, so the Fed is starting to ease, what does that actually mean for my business? Because we're all sort of speculating about that, but they plan for these things, right? This is why it actually matters, and the Fed cutting matters because it's how much these companies are going to have to pay to get a new loan and how that's going to impact their business. And also, Shauna, you just introduced an interesting point to this. Last week we were talking about, okay, the easing cycle has started. What do companies feel about that? Well, do companies actually think the easing cycle is fully underway here? Or are they now nervous that they're not going to get more cuts coming down the line because the economy is doing too strong? That's going to be an interesting part of this conversation, too. Certainly doesn't feel like anyone's going to be talking about recession this quarter. That will come down again, but we'll see.
We will see. Only time will tell. And you know what? If looking back over the last 10 or 12 months, whenever we try to predict something, at least mine tend to be wrong.
It flips the other way.
For myself.
Yeah, it flips the other way.
It
Of course.
tends to go the other way, so we'll see.
That's why we get to do this every day.
Very true. All right, Josh, great stuff. Thank you. Well, the markets have seen a bumpy start to October, under pressure today after rallying on Friday's blowout jobs report. Joining us now, we want to bring in Jonathan Krinsky. He's BTIG's Managing Director and Chief Market Technician. Jonathan, it's great to have you here. So let's talk about you closely watch the technicals here. When we see this massive run up in the S&P, your latest note was out titled Running in Place. And I know you're taking a look at the trading range that we've been in here for the S&P 500. So what does that then tell us? What are the critical levels that we need to watch when we're trying to figure out where this momentum trade goes next?
Yeah, so good to be here. We came into October thinking that we would actually have a down October, a red October, partly because we've been up 5 months in a row heading into October. Seasonally speaking, in election years, the volatility and the weakness tends to persist right up through the end of the month. That makes sense given the uncertainty of elections. And, we kind of were bumping up against that resistance level in the S&P, 5750. So we still think that there are decent odds that we finish October down or at least see some volatility. And that's the other point. Even in election years when October finishes green, there is almost always some sort of intra-month drawdown. And, we did have a little bit early last week, but I think, you probably, we should expect a bit more than what we saw last week. So that's still our base case, but the fact that the bulls did hold the line, that 5670 level was the prior highs back this summer. We held above that. So, until you can get a definitive close below that 5670 level, we think we're kind of probably stuck here. So we still don't see a ton of upside ahead of the election. I think that the uncertainty there will kind of cap things. As you guys have been talking about, there's also the Mideast uncertainty. So we don't see a big breakaway move prior to November. But again, until you can close below that level, it's tough to get any downside momentum going.
But Jonathan, we have big tech. Doesn't that always lift all boats?
It's funny. Big tech has been broadly taking a little bit of a backseat. We've seen, equal weight S&P and some of the other sectors kind of showing some leadership. So, you could argue that's a good thing. The broadening, if you will, it's been acting, the rest of the stocks outside of big tech has been acting better. So ultimately, I think that is a good thing, as long as big tech, doesn't falter too much.
Jonathan, when it comes to small caps, I think that's really been a focus here for so many investors, especially on the back of that 50 basis point cut here from the Fed. Now going forward, though, with future rate cuts, I think very much in question just in terms of the timing of them, the size of what they are going to be. You're closely watching some of that relative strength. What are you seeing there? And I guess could October maybe prove to be a bit different for small caps?
Yeah, I mean, the small cap trade has been frustrating for many. They seemingly got everything you would think they would have wanted in that we got the 50 basis point cut in September, which should have been good for them. And then we have firming economic data, which, is, you could argue that pulls off the table some future rate cuts. But I think ultimately, small caps would probably rather have a good economy than a bad economy with rate cuts. So I think, the fact that they got that and they still can't, really break out in absolute terms, and certainly in relative terms, they continue to struggle, is a bit concerning. But it might just be we need to get through this October period. So there's nothing ominous about them. It's more just a bit of a frustration. So I think if we were to get through November and the economic data is still holding up okay, and they still cannot show any upside leadership, that would be, a bit more of a bigger concern. But for right now, it's just more of a frustration for those looking for outperformance from small caps.
Do small caps require a more aggressive rate cutting cycle from the Federal Reserve than Friday's jobs print may have indicated to have more upside heading into year end?
Again, I think if you're asking what they would rather have, significant rate cuts or an improving economic backdrop, I think it's the latter, because as we know, if you have sizable rate cuts and that's into a recession or some sort of hard landing, that's not a good environment for small caps. So that's why, rate cuts with stable economic growth is probably the best setup. And we'll see how that plays out with the data going forward.
All right. Jonathan Krinsky, BTIG's Managing Director and Chief Market Technician. Thanks so much for joining us. We appreciate it.
Thank you.
And we're going to have all your markets action ahead right here on Yahoo Finance. So stay tuned for more. You're watching Catalysts.
Now time for some of today's trending tickers. Scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, looking at a call from Goldman Sachs, Chief Economist Jan Hatzius is lowering his risk of recession in the U.S. for the next 12 months to just 15%. That move lower coming after that strong payrolls report that we saw on Friday. And it's also important to note that it wasn't that long ago, I believe just about a month ago, that Goldman lowered its recession call or recession probability here in the U.S. from 25% down to 20%. So they're now reducing it even further. Again, that strong jobs print that we got on Friday, giving them further confidence about the stability and strength within the labor market. They talked about the unemployment rate dropping below a key threshold, also talking about the fact that just simply job growth continuing to exceed expectations. A lot going into this. Of course, the factor of immigration here within the U.S. that is playing a huge role in some of that strength that we have been seeing, or resilience, I should say, within the jobs market at this point of the economic cycle. And also, I think another thing that stood out to me within this report is the expectations here, Maddie, of what the Fed is going to do. Because I think very much there's lots of questions about if the Fed doesn't act aggressively enough, then maybe that could increase the chances of a recession. But here, Goldman is saying that they only expect the Fed to go 25 basis points at the next meeting in November. And even if they go 25 basis points, they're still very confident that the economy is not going to see a recession.
And on the flip side of that, they're not worried about the inflation picture so much as well, which is another way of supporting their call here, right? They talk about concerns about PCE disinflation. They're not so worried about that given the rebound in oil prices. They are still convicted in their call here. They talk about alternative rent indicators turning down as a potential example of disinflation, reinforcing their forecast that rent is going to continue to decelerate. Always good news for the renters listening to us. They also talk about the wage tracker coming up to 4% year over year, but the employment cost index is indicating a little bit more softness under the hood of that data. They also, I thought this was funny, they say the port strike ends any near-term risk to the economy, but that'll be a conversation that we can have with them again in January because it's coming back. All right, let's keep our eyes on Costco. Despite gold trading at record highs, consumers still buying those Costco gold bars. The retailer not disclosing that much about the gold sales overall, but a Bloomberg survey revealing how hard it is for Costco to keep the shelves stocked with gold. About 77% of surveyed Costco outlets saying that bullion bars were sold out in the first week of October, and that's based on reporting calls to 101 stores in 46 states. All of the stores surveyed had received fresh stock of the gold products in recent weeks. And Shauna, I feel like this is just people this is a great risk indicator. People are concerned.
It is a great risk indicator. It's something that we've been talking about now for quite some time. There was lots of excitement when Costco first started offering these gold bars, or at least I should say a lot of excitement when we first started to see demand spiking for these gold bars. And we've seen Costco really work to try to capitalize off this with the silver coins that they have rolled out. And then most recently, we talked about the fact that they're actually going to be selling platinum bars, 1 ounce platinum bars here after the success of gold and silver. So it's interesting when you stack this behavior up against some of that econ data that we've been getting out and the optimism that we've been hearing from so many strategists on the street. You wouldn't necessarily expect to see almost this flight to safety sort of trade or play a little bit here at this point in the cycle. But again, I think this also speaks to the fact that some people are a bit nervous just about where we are headed next. And as a result, they are going to Costco and buying gold bars. They are looking for demand here or wanting more exposure to silver and even potentially to platinum once we do get this new offering. But again, at least in terms of what this means for Costco, it has been a huge win for their business. And they've actually talked about this on their most recent earnings calls, too.
Yeah, something that's getting people in the stores, always good for foot traffic. And you've got Costco, there's plenty to buy and look for while you're there for your gold bars.
Almost too much to buy. You always come out of there with a lot more than you intended when you went through the doors. All right, let's talk about another trending story that we're watching here, and that is after the EU voted to add tariffs as high as 45% on China's electric vehicles, Volkswagen's CEO is voicing some concern. In an interview with Germany's best-selling A Sunday paper, the CEO said that he hopes for an alternative solution to tariffs on Chinese electric vehicles as he braces for potential retaliation from Beijing. And Maddie, this was one of the fears going into this, right? And I think that also just really illustrates the fact as to why the EU bloc was very split on whether or not to impose these tariffs against Chinese vehicles. Now, of course, the threat of retaliation, how much harder it could be, especially for the European car makers here, for their sales in China is a real concern, and also a concern here that could potentially pose as a massive overhang or a real challenge here for some of these companies in the short term.
Especially because Volkswagen has had all of their own fundamental issues over the past couple of months. They've had their second profit warning, I believe, at least 2 warnings in the last 3 months here. Questions about the strength of the German economy, Volkswagen being the biggest employer in the German economy, and it's going to be interesting to see whether or not this kind of tit-for-tat relationship of Volkswagen and Beijing in terms of the tariffs is going to continue to be a challenge for the business moving forward, and what that does not only to Germany but also the broader European economy, which has been experiencing a lot of headwinds over the past couple of months with deflationary pressures. Having said that, the focus for Volkswagen here, of course, is those retaliatory tariffs from China and the potential impact that could have on the business. You can see there on your screen, year to date, Volkswagen is down about 16%. Well, coming up, we're diving into Goldman Sachs' biggest conviction stocks. That's coming up right here next on Catalysts. Goldman Sachs out with its conviction list with 3 key areas in focus this fall: artificial intelligence, the state of the consumer, and sustainability. Joining us in studio to break down the findings from the report, we've got Steve Krohn, the Director of America's Equity Research over at Goldman Sachs. Steve, it's great to have you on to discuss this. So I know you guys call it the director's cut of Goldman stocks from your conviction list. Just give our audience the so what factor for this list in 30 seconds or so.
First of all, thanks for having me. It's great to be here. So conviction list director's cut is really meant to be a curated list of our top buy-rated fundamental stock calls coming out of the research department. To take a step back for your viewers, we have roughly 1,200 stocks under coverage in the Americas. At any given time, 500 to 600 of those stocks might be rated buy. So what we heard from investors is it would be great to have a list to help us distill down to what you think is most differentiated, where your analysts have the highest level of conviction. What we look for is high conviction, good risk-adjusted returns, and point of differentiation in the marketplace. And the feedback has been fantastic since we introduced this list last June.
So Steve, let's talk about some of the changes to this list. As we were going through it, there's a number of names that we want to get into, but let's start with the fact that you guys added Pinterest to this list, and then at the same time, you've removed Amazon and you've removed Guidewire.
Yeah.
Walk us through that thesis and why there's so much optimism surrounding Pinterest.
Yeah, so it's important to think about, we don't think of these as swaps or anything like that. We're keeping this list 20 to 25 names, and the idea and the discipline around this list is to ensure that we're keeping the list fresh. So in the case of Pinterest, Eric Sheridan, who's our analyst that covers Pinterest, has very high conviction on their ability to monetize their user base. And he speaks in his research about the various levers that they're going to pull, and he's starting to see that trend develop. All the while, he sees a lot of margin expansion over the next 5 years. He has 200 to 300 basis points baked into his projections of margin expansion per year in each of the next 5 years, which leads his earnings to be 6% above the street in 2025. And when we think about fundamental bottom-up research, we're trying to project the E and where we can find the differentiation. And all the while, on his risk return framework, he sees 3 to 1 upside downside on a name like Pinterest. You asked about the removal, so I'll just briefly touch on it. Just, look, we're trying to keep this list fresh and keep it disciplined. Amazon is still a top pick for him. It's one of his favorite names, Eric Sheridan, that is. It had been on the list since our inception back in June of last year. So as part of the discipline to continue to keep things fresh for our investor base, we decided to remove that. And Guidewire, both Amazon and Guidewire have been fantastic stocks.
So it's not necessarily that he's changed his view at all, just in terms of the degree of bullishness, but really it's just a rejiggering as to a name that maybe better fits into your vision, Goldman's vision here of
Correct. And I should say, unlike many other lists that you see out in the marketplace, these ideas on this list are sourced from the fundamental work, the good fundamental work that our analysts do. And the names are selected by a subcommittee of our internal investment review committee. We spent a lot of time on investment process and spent a lot of time with our analysts talking about stock recommendations. And so these are sourced from them. But yes, their views have not changed. They're buy rated.
It makes me think about, too, I was able to speak with Toshiya Hari, who is the analyst behind NVIDIA, about his call on the stock, obviously a buy rating. You call it the shovel of the AI gold rush. And he said the sell-off that we saw in NVIDIA following their earnings was completely overdone. What is the bull case for NVIDIA now, especially as we are getting closer to their next quarterly earnings print?
Sure, and we just had Jensen speaking at our Communicopia conference a couple of weeks back. Look, NVIDIA's been on this list for about a year now. And you may say, you said differentiated ideas. How could you be differentiated on NVIDIA? It would be a natural question. For the better part of the past year, Toshiya's earnings estimates have been 20% above the street. And all you've seen is upward revisions. So there's differentiation in that without even the need for multiple expansion. And I think, and we think, as the AI infrastructure development continues to play out, NVIDIA's right in the sweet spot of that. So he's still about 6-7% above the street on earnings, and we expect revisions to be higher.
Not having NVIDIA on a list like this, I think, would be a bit of a surprise for investors, just given the massive mood and growth and everything that we're expecting to see going forward. See, let's switch gears here because we're short for time, and I want to talk financials. And one of the names within the financials that you guys like that's on this list is Citigroup. We're about to hear from the bank here in just a few days as we kick off third quarter earnings season. What is it about Citi that Goldman views as the differentiating factor, especially when you compare it to some of those other larger big banks?
Yeah, so the analyst there, Richard Ramsden, has been out with a call where he thinks that Citi is able to drive top line all the while with cost control measures that they have in place to drive margin expansion better than others that he covers, which is important in that it's leading to a return on tangible equity north of 10%. I think he's at 10.2%, which is driving the cash flow that he thinks they could start returning to shareholders in a bigger way.
Is that indicative of Jane Fraser's kind of defensive work on the balance sheet since she started doing a lot of cost cutting, in particular with regards to labor at the company?
Yeah, I'll leave that to Richard, but yes, it would seem as though the way he's modeling this out is a combination of both the ability to drive top line while also controlling costs.
Steve, how much, when you take a step back from this list, and Maddie started the conversation talking about some of the themes with sustainability, the AI, and the consumer, what do you think that tells us just about where we are in the economic cycle and factoring in the equity side of things, just where we really see that growth here going forward as we talk about that next leg higher?
So I heard you guys reference earlier, Chief Economist Jan Hatzius, lowering his recession probability to 15%. He's been above consensus for GDP growth in the U.S. in particular, and been right with that call. And also our portfolio strategists on Friday raised their earnings expectations from a top-down standpoint to 11% growth next year. We're about sort of the bottoms up, and you mentioned themes. We don't manage this list top-down themes, but what's interesting is the discovery that you get when talking to analysts, because the themes certainly play a role in their fundamental bottoms-up stock picking. And I think what it's telling us right now, interesting to one of your prior guests, is that there is a broadening out of the market. That's the expectation that we have. And organically, we have a lot more mid-cap names on this list than we had 6 months ago. Roughly half our list, you can say, is in that mid-cap sweet spot. So I think that is certainly a theme in the marketplace. You mentioned the consumer. We as a house, both our macro team and our bottoms-up research fundamental analysts, have been above consensus on their expectation for consumer spending, and they expect that to continue going forward.
Another bullish signal for the U.S. economy there. Steve, thank you so much for joining us. Really appreciate it. Great insights into the conviction list as well. Really appreciate it. Well, another stock we're keeping our eye on today is Apple. Jefferies analyst Edison Lee assuming coverage of the stock with a hold recommendation. The firm previously had a buy rating on Apple, viewing high expectations for the iPhone 16 and 17 as premature. That is the key reason behind the call. Lee is saying that the lack of material new features and limited AI coverage could mean high market expectations are unlikely to be met, forecasting flattish volume growth for the iPhone 16 in the second half of this year. And I think this is something that we've heard from a lot of various folks across the street, Shauna, when we talk about Apple and the fact that they were releasing the iPhone hardware before the software that had all the AI goodness in it, saying that the iPhone expectations for sales are premature. That's certainly a strong word choice for Apple moving forward here. And again, this change in the rating on the stock also certainly leading to some pressure on the name. I know Apple shares were down about 1% off the news. You can see over the last 5 days here on your screen, down over 3%.
Yeah, and I think, Manny, you mentioned the fact that this is far from the first report that we've gotten out from analysts, or maybe first warning that we've gotten out from analysts, that maybe iPhone 16 sales aren't necessarily going to live up to the hype that had been factored into the stock here up until recently. And you mentioned the outperformance that we had seen here for Apple. Stock is up about 33% over the last 6 months alone. So there was a lot being priced in terms of what exactly these AI capabilities, these AI features were going to do for demand going forward. But when you take a step back and take a look at where Wall Street stands today, just 65% of analysts recommend a buy rating or buying the stock at this point. And I say just because that's compared to over or around 90% for those that cover Microsoft, Nvidia, and Amazon. So when you stack it up against some of its Mag 7 peers, some of its larger cap tech peers, the street is a bit more cautious just in terms of maybe what the next 12 months is going to look like. So again, we have seen a number of analysts coming out, whether it is their own metrics, whether they're citing various surveys coming out and saying maybe demand isn't going to live up to the hype. And it also reminds me of a conversation that we had with Needham's Laura Martin shortly after the iPhone 16. I think it was the next day after the iPhone 16 was announced. And she was saying that there was too much mention of next year or promises for the future to really get investors excited or even consumers excited about buying the iPhone 16 here today. And at least it looks like from the early reads, she may have been right. And maybe many people are waiting on the sidelines to get more of that conviction as to the fact as to why they need to upgrade their phones now in order to use those AI capabilities.
Right. Why buy now when you could buy in 6 months and then get all that AI that we are anticipating? All right. Well, we are going to cover all this and more when we come back. We'll have all of your markets action ahead right here. This is Catalysts.
Analysts sounding mixed on Netflix here this morning. Piper Sandler upgrading the stock. On the flip side, Barclays downgrading the streaming giant. All this happening ahead of their earnings report scheduled for later on this month. Yahoo Finance's very own Alexandra Canal tracking this. And Allie, what's the story here? Because one side a little bit more optimistic, the other side having some questions just about, I guess, short-term growth.
Yeah, a bull and a bear case for Netflix to kick off this week, and really valuation is at the center of both of these calls. So let's start with that downgrade. Barclays downgrading Netflix to underweight from equal weight, saying it believes that revenue growth for the company, it's going to be more and more difficult to maintain amid its high premium valuation. And this is a thesis that I've really heard in my conversations with other analysts as well, because this is a game of big numbers, especially since Netflix is viewed as a growth company given that high valuation. Because of that, the expectation is for the company to deliver around 15% year-over-year revenue growth in 2024. And that's a very tall order. Barclays arguing it's an unrealistic goal in some senses because the company, even if it does hit revenue expectations, the valuation implies that it should double its subscriber base. So that's the argument on the sell side. Now, for the good news, Piper Sandler says that Netflix stock, it's expensive for a reason. Piper upgrading shares to overweight from neutral, saying that there are still levers to be pulled when it comes to its premium ad-free subscription business, that the company has the pricing power to offset subscriber growth, and that is what's going to keep revenue sustained over the long term. Now, we have heard some rumors on Wall Street that Netflix is well positioned to potentially raise prices later this year, so perhaps that's something to look out for. Of course, the company will be reporting earnings next week. Wall Street analysts expect Netflix to deliver about 15% revenue growth. Earnings are also expected to surge by about 40% year over year, according to the latest estimates from Bloomberg. So a big report here that's going to set us up through the end of the year. But again, I mean, you're looking at a stock that's priced at over $700 a share. So you wonder maybe if there's a stock split that the company should be considering moving down the line, if it's a little too expensive. So we'll see.
I thought they just raised prices. Didn't they? No?
Yes, they took away their basic plan.
Okay, yeah.
So that forces people to get the more expensive plan, but perhaps that $15, $49
people are paying it, so I guess why not? If you have that pricing power,
exactly,
it makes sense to raise it.
And they haven't raised their ad-supported tier either, and it's one of the cheapest ad-supported plans on the market right now. So perhaps that's something that they could be thinking about as well.
Well, it's interesting, too, because it reminds me of NVIDIA, the fact that expectations are so high going into the print. And I remember we talked about this a little bit last week. Some of the numbers you ran through for Netflix were so positive. And then you were like, and it might be a bad response to their earnings. And Josh and I were like, that doesn't make any sense.
A victim of their own success. And that was based on their viewership report. So their engagement, the amount of time that people are spending on the platform year over year, that was pretty much flat. And that's what we were sort of joking about, is that the numbers are still very good. 900 billion hours watched, but if you're not consistent and growing that over the long term, then that's something that investors start to question and say, okay, why is that the case?
And I also know, Allie, just to switch gears a little bit, the movie Joker was released over the weekend here, certainly missing expectations in its opening weekend.
Yeah, expectations at one point were as high as 100 million for that domestic opening weekend. That was revised lower, between 50 to 60 million, but we only got about 40 million in that domestic debut. Internationally, we saw about $81 million, so a bit of a disappointment and a surprise too, especially since we've seen these movies that are sequels, that have built-in IP, that built-in audience. Typically, those types of films do well at the box office. That being said, though, we did have a pretty strong summer overall. It seems like this movie was a victim of bad word of mouth. We know how crucial reviews are. We know how crucial word of mouth is. So we'll have to continue to wait to see if they can potentially bounce back in weekend 2, 3. This could be a type of film that we see over the long term get to where it needs to be, but certainly the opening weekend, not too good.
The buzz is that the movie is not good.
Yeah.
So
it is,
I'm not.
Which I'm a bit surprised by.
Especially because of how well the original did
Exactly.
in 2019.
Exactly. It was a massive hit.
Yes.
Yeah. Well, Allie, thank you so much. I guess we won't be seeing the Joker anytime soon, guys, but we will see. Thank you so much, Allie. Appreciate it. A trending story that we are following to close out our show. Car enthusiasts buzzing about the McLaren W1, the latest addition to the company's prestigious 1 series of supercars. With its impressive speed and cutting-edge design, the car carries a very steep price tag. Yahoo Finance senior auto reporter Praz Subramanian has the details for us. Praz, tell us about the car here and how much it's going to cost consumers.
You know, you talk about Joker. This is really the Batmobile, this new W1. If you ask me, I think it looks totally swooping and very sort of sci-fi, and it's sort of looks. And that's because that's sort of the technology aspect that McLaren is going for. You know, this car follows in the line of the one car you see, right, the P1 and the F1, which are phenomenal cars that came out, just the cutting edge technology. Here, of course, you have a hybrid powertrain, putting about 1,300 horsepower to the rear wheels, which is kind of crazy. It also has F1 derived race technology, like an active aero wing that deploys and comes back on its own based on the speed of the car. But you mentioned that price, right? It's going to be pretty steep here, $2.1 million price tag. But look, this is the rarefied air that we're playing in at the top end exclusive models from Ferrari and Bugatti here in that same sort of price range. McLaren CEO, former Ferrari man himself, said the Italian brand with the prancing horse is McLaren's target here.
So, Bros, what do you think how this all plays out in the secondary market? If you're paying for one of these, you obviously have a good chunk of change. But when we're talking about longer term value, is this something that we expect maybe to rise in the secondary market?
Yeah, I think so, Sean. This is part of the calculus why rich people here who buy this car, they don't want to lose money too, right? They want to make money. And the hybrid car market is an interesting one. The W1 here would eventually kind of compete with the Ferrari LaFerrari, which is what it's called. That's another hybrid car, and also Porsche's 918, and also the prior McLaren P1. You know, Haggerty tracks these dollars. You can see that right here. The LaFerrari, the gold standard, around $4 million here, had a little dip in pre-pandemic, but stabilizing here. The McLaren P1 and the Porsche dipped as well, stabilizing around $2 million. But if the McLaren F1, the car from the 90s, is the true comp, that car is going for over $20 million a pop these days, the few that are out there. But I think that's probably McLaren's target here, to not only sort of have these cars have a really good future in the secondary market, but also boost the brand overall by having this car out in the market itself.
All right, Pras, thanks so much for breaking that down for us. And of course, you can check out Pras's story on yahoofinance.com. Thanks, Pras.
Thank you.
Well, coming up, we've got Wealth. It's dedicated to all your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks to grow your money. On today's show, we're talking about building out your portfolio and what place AI should have in your investments. Plus, retirement in America. We'll discuss how real people are coping with their personal finances as they enter this stage of life. Plus, thinking of purchasing your flight home for the holidays? Well, we'll reveal the best time to book for Thanksgiving and Christmas and holiday travel here. All that and much more coming up during this hour. But first, let's zero in on a critical trend in the markets this year. The artificial intelligence boom just getting started, and ARK Invest CEO Cathie Wood is betting big. Yahoo Finance's Josh Lipton is here now with a closer look at the opportunity. Josh.
Brad, there is no bigger trend for investors than the mega trend of AI, and a company we all associate with that trend has been making headlines. OpenAI, company behind ChatGPT, recently announced that it raised $6.6 billion in new funding. Investors valuing the startup at an eye-popping $157 billion. Now, just to put that into context here, it's a similar market capitalization to publicly traded companies like Goldman Sachs. This round was reportedly led by venture capital firm Thrive Capital. Other investors included Microsoft and new investors such as SoftBank, NVIDIA, and Cathie Wood's ARK Investment Management. Yahoo Finance recently did speak with Cathie Wood and asked her why she's so bullish on this startup. In part, she talked with us about how revenue has been growing very strongly, her confidence that the company will be able to charge a lot more in the future for its technology as it develops, and her trust in OpenAI Chief Executive Sam Altman and his management team despite a number of recent executive departures.
We always look at who they are bringing in and who they are retaining as talent. And we think one of Mira, the CTO who just left, I think she has built a very solid organization. And we love the fact that Sarah Fryer has come in as CFO. I've followed Sarah since her Goldman Sachs days, through Salesforce and Block. And she's an incredible leader. So to attract her spoke volumes to us.
So how does business look for this young company right now? Well, it is growing at a very impressive clip. We know that with 250 million weekly active users, 11 million paying subscribers. It is expected to generate revenue this year of $3.7 billion. That's according to the Wall Street Journal. But it is still far from profitable, expecting to lose around $5 billion. Its investors clearly willing to give that a pass for now as it grows. Looking ahead, per reports, OpenAI estimates that its revenue will surge to $11.6 billion in 2025, Brad.
I mean, the likelihood that this company is going to need to go public anytime soon with funding infusion like this, what do you think?
I think you could make the case that though an IPO, and I don't know time frames, you would think that it has to happen at some point, Brad, because they do, I mean, to develop and operate AI models costs a ton of money.
Yeah.
You have to have big AI brains working at the company, right? That's a lot of money. And there's no way a trust buster in Washington is ever letting a big tech company buy this one.
True. Well, the exposure right now is investing into the companies that have investments into OpenAI for sure. Josh, great breakdown as always. Appreciate it. Well, many Americans aren't as well versed in investing as Cathie Wood, and 51% of Hispanic and Latino women and 46% of black women just started investing outside of an employer-sponsored account less than 5 years ago, according to a report by JP Morgan Wealth Management. Here with information on the top priorities and concerns among this investing cohort and group, we've got Veronica Navarro Espinosa, who is the head of communications for JP Morgan Wealth Management. Great to have you here with us in studio.
Thank you for having me.
Absolutely. Let's dive into some of these figures as well. As we start to think about where people are getting more exposure to investing, where can we continue to break down some of the barriers that are kind of creating a harder entry point for many individuals?
That's a great question. And I got to tell you something. We've done this study for 3 years, and we're starting to see some progress. And exactly because those barriers are starting to get lower and lower. One is the education barrier. Investing is overwhelming. There is so much information everywhere that it's hard to decide where you're going to go. But we're starting to see that there is a path forward. We're seeing people are starting to be more comfortable. Also, the tools to invest are becoming more accessible. They are cheaper and they're easy to reach. And also the myth busting. There is a lot of obstacles, but there are like knowledge obstacles that don't allow people to invest. For example, a lot of people think that they don't have enough money to invest. Yeah. And we know it's not a question about how much money you have, but how early you start and that you are able to invest regularly. And we're starting to see, not by gender, not by race, by age, that millennials are more knowledgeable and they understand they don't need a lot of money to start investing. So a lot of progress, but it's still a lot of barriers. On the barriers, the confidence keeps being an issue for women. So we need to do more about that education, and particularly educating women.
Yes, certainly. And so as we think about what this means towards narrowing and hopefully at one point and one day eradicating the wealth gap as well among genders too, and then you go even further into ethnicities as well, when you think about how we are ensuring that we're removing these barriers, where is the translation through to narrowing the wealth gap and certainly closing in the space there?
Two things I want to mention here. Again, the education. We are seeing, and you mentioned it at the beginning of this segment, that Black, Hispanic, and Latino investors acknowledge that education is key. The 80%, more than 80% of them are putting more money into education purpose accounts, like 429s than a year ago, like the same amount or more amount. So they understand that education is key. But also, we're starting to see when we ask them, what are your motivations to start investing? They are telling us that generational wealth is the motivation for them to start investing. And let me explain that to you. The motivation for them is to be able to pass wealth, money to the next generations, because they understand we are not all starting on the same level. Those who start ahead go further, and they understand that, and they're doing something about it.
Certainly. And so how is this really shaping where and what types of assets they're investing in from what you've seen?
We are not asking about particular assets in our study. We just ask that they have at least 25,000 in investable assets. That includes from insurance policies to CDs, savings accounts. It does not include real estate. But just let me talk like broadly. We know, and we talk about time in the market, being able to contribute regularly to accounts, but also being able to have a diversified portfolio are keys to success. And in this study, we also found out, and this is something that you probably, if you like plans, you're gonna love. If you hate plans, you're gonna hate. And it's like having a plan actually works. We're seeing people who have a financial plan, they feel more confident, they feel better, and they do something else that is very important. They talk to their children about money. And we know to have a successful financial career, to be able to hear about money at the dinner table is very, very important.
Absolutely. And so with that in mind, when you think about the generational wealth that they're trying to create, because that is why that conversation takes place. Here's how I'm setting up my investment strategy that plays into our overall financial plan so that one day we can also set you up well as well. How are you seeing the generational wealth conversation taking place at the table for so many Latin, Black, Indigenous, people of color, investors who are women?
So we do know, as we said, that hearing about money at the dinner table makes a difference. We are starting to notice that they acknowledge that, the Hispanic and the Black communities. We saw it in previous surveys, that they acknowledge that it is important. And now we have another key, which is if you have a financial plan, you're going to start talking about your children about money. And maybe it's because you feel more confident. So just another tip out there. There are plenty of tools in the market to build just financial plans. I don't know if you're a Chase customer. I'm going to assume you are. But if you are, or anybody, if they are, we have a phenomenal financial plan financial tool. It's for free for everybody in the Chase app. And I'm going to tell you why it is important. Because retirement, when you talk to young people about retirement, they cannot see it. It's hard for them to grasp retirement when they are 40 years away from that. These tools, what they do is they bring the future to the present.
present. They tell you if you want to go on vacation to Hawaii and Alaska, go for it. But it might mean that your retirement is going to be delayed 3 years or 4 years. And that helps you make a decision of what your present decisions are going to be. And also it helps you see where you're standing. Like how much money you have, how much debt you have. You should have all in one place so you're able to see it.
Absolutely. Well, you will be proud to know at least that I was a Chase intern at one point. How about that?
I am very happy to hear that.
Exactly. Veronica Navarro Espinosa, JP Morgan, a wealth management head of communications. Thank you so much for taking the time to do that.
Thank you very much. I didn't know.
Absolutely. Yeah, look, surprises everywhere here. Everyone, let's do a quick check of the markets here. We're a little over 90 minutes into the start of trading here on the day. Stocks are slipping today, failing to keep up with the momentum from Friday's rally on the heels of a strong jobs report. Investors watching for the next big catalyst for the markets, and that is earnings. To discuss what themes you should be watching, we've got Keith Buchanan, who is the Global Investments Senior Portfolio Manager. Great to have you here with us, Keith, as always. You know, as you think about some of the themes that could prevail over the course of this earnings season, as investors are looking to what catalysts will be next, I mean, it seems like the flame on AI is starting to peter out a little bit. So where else does that kind of shift some of the attention to in this broadening out we've been talking about?
Absolutely, and thank you for having me. We've done a lot of work in this regard, and what we've noticed is the expectations for earnings have started to accelerate from mid-single digits to next year to mid-double digits, and this fourth quarter, coming into this fourth quarter, is really a transition quarter from that lower healthy growth to robust growth. And a lot of that comes from not only being, of course, healthy growth from artificial intelligence and all those industries and companies that benefit from that trend, but also a widening of earnings growth, revenue growth that you can see beyond the traditional growth sectors like technology, consumer services. That's actually moving out some to industrials, energy, and that's a more breadth to the earnings growth, which gives it a lot more stability over the near and longer term. So we're really excited about what earnings prospects there are. We've started to broaden some of our risk to get more access and, frankly, a lot more exposure in a relative sense to those sectors that have been forgotten, and valuations reflect that.
You know, it's interesting. Over the course of this morning, especially as we've been teeing up the outlook for the final quarter, and then what themes could prevail even going into 2025. We've heard everything from utilities to industrials and manufacturing. What are your top picks or your top sectors that you are kind of positioning around and placing a little bit more strategy around going into, and as we've kicked off this fourth quarter and then have the outlook into 2025?
And that's different from what we've seen over the past year, where a lot more focus has been on AI and the NVIDIAs of the world that seem to benefit from this trend. We're looking towards the traditional, call it even, I hate to say the V word, but the value spaces that offer a little more bang for the buck when it comes to potential for return and earnings growth per the valuation that you have to pay for it. So we're looking at financials as being one of those that has already started to benefit from that trend as far as the investor interest is concerned. We'll also see spaces in industrials, consumer discretionary, those spaces that have been left behind, frankly, from a return standpoint, and those valuations are miles away from where they traditionally trade on a relative to the broader S&P 500. So we're looking at spaces outside of what's kind of been talked about as the best names and best ideas over the past couple of years. And those have started to lose some relative steam. We want to make sure our clients are exposed to a broad array of names, not just focused on those names that have done well over the past couple of years.
Keith, as we continue to evaluate, a multitude of events that seem like they're taking place. I was kind of thinking back to a friend of the show's tweet that I saw this morning, Ryan Dietrich, and he had mentioned the S&P 500 being up 34.4% over the past 12 months, ending in September of this year. And you think back to how many times we've been told that something bad is happening right now, whether it be elections or the events over the course of this year, as we've had more than half of the world's population expected to participate in elections, or you've got wars, you've got, of course, just 7 stocks that people have been focused in on. All these things considered, are any of these events having or continue to have a more outsized impact on the trading strategy that you are recommending to clients right now?
Absolutely. We take all of that into consideration when we make our changes and have our position for our clients. I mean, look back to where we were in 2021. perfect example of kind of how we are viewing the world right now. Had a tinderbox of port issues. We also had Russia on the border of Ukraine. That invasion kind of made inflation, which was widely thought of to be transitory, no longer transitory. Right now, we're having issues, of course, a brief resolution last week. We're having issues as far as port availability and also some backlogs associated with that. We have a sprawling conflict in the Middle East, very resource-rich part of the world, just like Ukraine and Russia. So we're taking note of just how similar those time periods were, as well as the geopolitical conflicts that could really light a match to what seems to be a tinderbox of risks that could be more widespread than we assume right now, which was the same case in 2021. So all those are taken into consideration. We don't necessarily make election trades per se. We want to take all of the incoming information that we have that could affect the consensus of where we're going economically, monetarily over the next 2 years, and take that into consideration when we're thinking about the long-term approach to our clients' assets.
Keith Buchanan, who's the Globalt Investments Senior Portfolio Manager. Keith, always a pleasure to grab some time with you. Thanks so much for hopping on with us.
Absolutely.
Coming up, everyone, Social Security recipients, listen up. The 2025 cost of living adjustment, COLA, as you know it. That adjustment to your monthly payments will be announced on Thursday. We'll key you in on everything that you need to know after the break. But first, third quarter earnings season starts this week. We're going to give you a little breakdown on how to read an earnings report. Fourth quarter earnings season is about to kick off in earnest. Here with what you need to know about what company earnings are and why they matter. We've got Catalyst co-anchor Maddie Mills. Hey, Madison.
Hey, Brad, thanks so much. So think of it as a quarterly report card for public companies. Every 3 months, these companies are required to publicly disclose their finances. Now, earnings often contain some executive commentary, forecasts moving forward, or statements on just the general macro environment. So we're going to run through 4 things investors need to watch out for and why they matter for every earnings report. I want to kick it off with the earnings themselves, right? Also known as profit or the bottom line. This is the amount of money the company earns after their expenses. And it's often calculated as something we call EPS, which stands for earnings per share. That tells you the amount of profit per share of the company's stock. Another thing you want to watch out for is revenue. That's also known as the top line. Revenue is the total money generated from business operations. It's all of that money coming in before expenses are even deducted. Now, moving forward here, you also want to monitor guidance. Sometimes companies will report to you how they think they're going to do in the future in the form of guidance. And this can vary, right? Companies can provide this for the next quarter, the next year. The guidance could also be about revenue, sales, earnings, really whatever they want. And that's a key indicator of the company's health moving forward. So now that we know the basics here, let's talk about how earnings are evaluated. One really key thing to monitor heading into earnings prints: analyst expectations. These are those individuals who monitor company performance. They're paid to do that throughout the quarter, and they publish calls on what they expect company earnings to look like. And you can compare the actual results from these companies to those analyst expectations for a sense of how well that company did. A company can beat on one part of the earnings print, like revenue, but then miss on another metric like profit, and that could lead to what we call a mixed earnings print. Now, guidance is really critical here. Even if company guidance is positive, if it comes in below the street's expectations, you could see pressure on the stock following the earnings release. Nearly every company will hold a conference call after releasing their earnings report. Wall Street analysts are usually the ones asking questions to executives about the quarter and outlook. Now, those calls typically add more color to the last quarter, the industry environment, and what's coming up next for the company. Ultimately, those reports are important for you and your money because they determine how the company is doing and where it could be going, Brad.
Hurricane Milton is rapidly intensifying into a Category 4 hurricane with sustained winds of around 150 miles per hour, according to NOAA. The storm expected to make landfall Wednesday in Florida around Tampa Bay, an area still reeling from the effects of Hurricane Helene just over a week ago. Here with more, we've got Mark Friedlander, who is the Director of Corporate Communications at the Insurance Information Institute. Mark, good to have you here with us. As we're continuing to grapple with this hurricane season and some areas set to get hit one after another with Helene and now looking at Milton, what are some of the economic damages that we've already seen come forward to the extent that they can even be quantified at this juncture?
Well, Hurricane Helene in Florida was a very moderate loss event for property insurers, most likely a $1 billion to $2 billion loss because most of the damage was caused by storm surge, and storm surge is covered by flood insurance, not property insurance. So we consider that a very moderate loss event, especially for a landfalling Category 4 hurricane. But at this stage, it appears that Milton will be a much larger wind loss event because not only will it impact potentially the Tampa Bay area, but go up the Interstate 4 corridor through the Orlando area, and it will stay at hurricane strength throughout the state of Florida.
And so with that in mind, as you're thinking about how people can make sure and households can make sure that they are covered and check their coverage, what should they be looking for, as they should in any hurricane season, but especially given the intensity that these two systems have moved through with?
Well, unfortunately, it's too late to make changes to your policy once the storm warnings have been issued. But you want to make sure you understand your coverage. Do you have property coverage? Do you have flood coverage? Because this type of storm could bring both types of damage. And make sure you have a home inventory where you have detailed information and photos of all your possessions, because if you do suffer a loss, a home inventory will make it much easier to file a claim after the event.
And when you think about that claim filing, what type of time frame should people and the insured be expecting when from the time that they submit a claim to the time where they ultimately are able to see some of those remittances?
It depends on the complexity of the claim, but one of the most important components of your policy is called additional living expenses or loss of use. That's for coverage if you are displaced from your home and have to move to a hotel. You would get those funds immediately from your insurer if you are in that situation. So that's the first step, filing the claim and then getting funds to cover your temporary living if you are displaced.
You know, I was also looking at a survey, and I'm not sure if you saw this earlier today, but Redfin put out a survey saying nearly 1/3 of young adults say Hurricane Helene has made them reconsider where they want to live in the future. How could storm systems like this impact the very fabric of how people think about where they want to move, where they want to set up a long-term residence and ultimately, take on a 30 or 15-year mortgage?
It's understandable, the concerns about a storm that is so powerful like Helene and unfortunately so tragic as well. However, all areas of the country are prone to disasters. Nobody expected Hurricane Helene to cause catastrophic flooding in the southern Appalachians. You are not immune to disasters no matter where you live. There's different type of hazards, and you just need to be aware of the hazards where you live and make sure you are financially protected with property insurance and flood insurance. And that goes for all 50 states and Washington, D.C.
All right. In the wake of Helene and now as we're bracing for Milton, our thoughts are certainly with those who are in the path of these systems as hurricane season continues to roll on. Unfortunately here, Mark, a lot more coverage that's going to be coming forward on this. Mark Friedlander, Director of Corporate Communications at the Insurance Information Institute. Appreciate the insights.
Thank you.
Certainly. Well, inflation has continued to moderate over the past year, yet many retired workers are still feeling pinched with post-pandemic price increases. Later this week, Social Security recipients, they are likely receiving some much-needed relief. Retirees are expecting to see another increase in their monthly benefits thanks to the cost of living adjustment, known as COLA. Yahoo Finance senior columnist Carrie Hannon has the details on this COLA adjustment for us. Hey, Carrie.
Hey, Brad. We'll get the numbers when the inflation numbers come in on Thursday. And what happens is the cost of living adjustment is sort of the equation is they take the inflation data from July, from August and September, and they put it all together in a magic calculator, and they come out what the cost of living adjustment for Social Security beneficiaries will be starting in January. So what I'm hearing out there right now, and if we look at what the numbers have looked like in July and August, we're looking at something like a 2.5% increase. Now, last year, or I should say this year, for 2024, there was a 3.2% bump up. So for 2025, it'll be 2.5%. And what that means is when you look at the average Social Security check is for retirees is around $1,870. We're talking about a bump up of maybe $46. I mean, it is helpful, and it's certainly something that's important. And the fact that Social Security does adjust for inflation in itself is a great thing. But the problem here, Brad, is that many seniors still grapple with rising healthcare costs and rising housing costs and other variables that, while yes, inflation has cooled overall, there are pockets where seniors spend that really haven't felt that cooling off. And so that's what there is some concern. But, at least, the statistic is something like 1 in 4 seniors, they rely on their Social Security check for 90% of their income needs each month. So that's why this is a super important number, and the adjustment is something that matters.
Carrie, while we have you, Americans are growing increasingly concerned that they won't be able to retire comfortably. It seems like there's a lack of clear solutions from both politicians and financial planners on how to address this growing crisis. So is there a solution here?
Yeah, Brad, it's really a mess out there. I got to tell you, I just have a big piece that's on Yahoo Finance that I spent a year reporting, taking a look at, talking to experts all around about, are we in a retirement crisis? And the fact is, Americans love to spend. They are really terrible at saving for retirement. We are undersaved. And many people, of course, there's that segment of the population that, is making a healthy wage, and their employers take money out of their paychecks and automatically they start saving. But in fact, many, many Americans do not have access to an employer-provided retirement plan. 50% of the population in the private sector, in fact, do not. So, it's troubling, and seniors are heading into retirement with massive amounts of credit card debt and medical debt. So a lot of my experts are very concerned, and we're saying, what can be done? See, what happens also, Vanguard came out with a report this morning that's showing that over a career, someone might change employers 8 times, and each time they get behind on their retirement savings. And so they calculated it was something like $300,000 in lost retirement savings by switching jobs. Other people, when they switch jobs, and I admit I did this myself when I was young, cash out their retirement money. And so they no longer have that savings, and they pay the tax, et cetera. I think you and I have had this discussion before, but it's troubling. And so how do we get our hands around getting people to focus on their future? And younger people are getting better because new tax laws new laws that came in this year enabled more states have started to set aside funds for private sector employers who don't have retirement plans, to get them into these state-sponsored plans. There are about 20 states that now are offering these kinds of things. Also, there's ways for people there's more auto enrollment, there's more auto escalation. So these things are happening as part of some of the things that are changes coming through. But there's a lot more that has to be done because, for example, Medicare does not cover assisted living costs, which are soaring. So we're all looking for solutions. Social Security, huge issue. We've got 9 years until the fund starts to tap down lower, and potentially 20% of benefits would be cut. So, this is something that the best minds in our country need to start thinking about, and we're hopeful moving forward we're going to see some of these changes.
All right, some critical reporting there and a lot of fact-finding over the past year. Carrie, thanks so much for bringing this to our attention, and some continued reporting on it as well. Certainly appreciate it.
Thanks, Brad.
Coming up, everyone, we're breaking down the Biden administration's student loan forgiveness plans and how it impacts your wallet. That's right after the break. Headlines about student loan changes pretty often this year, and if you're a borrower, it's hard to keep up. So let's go through what's happened so far for the Biden administration's broader student loan forgiveness programs. Now, you've probably been seeing the administration's latest plan, let's call it the Cancel Runaway Interest Plan, in the news, and it was introduced in April of this year. Now, it would cancel up to $20,000 worth of accrued interest and aims to forgive outstanding balances for borrowers who started repaying their loans a decade ago. It was allowed to proceed, then temporarily blocked, then greenlit, then temporarily blocked again last week, sending it into legal limbo for the foreseeable future. Now, there's another Biden administration initiative called the Saving on a Valuable Education Plan, or the SAVE Plan. It's an affordable payment plan with some forgiveness attached to it. That plan was put on hold after a U.S. Court of Appeals prohibited the administration from implementing parts of the plan that were not already blocked by two lower court rulings. Basically, that means it's still sitting in legal purgatory. Payments for those enrolled are in administrative forbearance, and their interest rate is set at 0% until it gets sorted out. And before these two sweeping rules, there was a different student debt cancellation back in 2022. The administration instituted a one-time student loan debt cancellation for up to $20,000 for eligible borrowers who met specific income requirements. A bunch of states not happy about this. They sued, and it went all the way to the Supreme Court, the SCOTUS. And in 2023, SCOTUS ruled against the administration, and there's been even more student loan programs targeted towards specific groups. In light of all these changes, though, to break it all down, we've got Elaine Rubin, who is the Advisor's Director of Corporate Communications. Elaine, great to have you here with us. Okay, so make sense of this all for us. What is still in limbo, and what have people been able to take advantage of to this juncture, and is there more relief on the way?
So essentially, these plans are both halted, the SAVE plan and the broad forgiveness. Borrowers have been looking forward to some type of relief that has been promised in the Biden administration, but he's been challenged every step of the way. The SAVE plan is that income-driven repayment plan. There are some other income-driven repayment plan options out there, but anyone in the SAVE plan, like you said, they're on hold right now. And broad student loan forgiveness hasn't even had its final rules published, and it's already been halted before that has even happened.
And so what have we heard about, as this is also going to be perhaps one of the bigger talking points for political candidates going into the election, and has a broader economic implication as well, because one would think, at least in theory, if some of the student loan forgiveness were to move forward, were to take place, that would have other benefits for people who are, starting a family, or if they want to purchase a house, all of these other economic contributors as well. So what are we expecting and anticipating to hear?
So in this election year, we know that the Kamala administration, they are aiming to continue some of the plans that the Biden administration has already started. So defending the SAFE plan and going towards that broad forgiveness. The Trump administration has been relatively quiet on these specific plans. However, when it comes down to it, there are some very significant platforms that he's running for in higher education, including some of the platforms of eliminating different types of forgiveness options and potentially even eliminating the U.S. Department of Education. So that would be a completely different route than the Biden-Harris administration has taken. So for borrowers, there's a lot up at stake at this election, and there's a lot for them to consider when it's time to vote.
Okay, so say you are paying down student debt right now. I want to give people some actionable tips that they can use, whether or not they are enrolled or trying to be enrolled or met the deadline for any of these plans.
So the SAFE plan, if you're already enrolled in the SAFE plan, essentially when student loans re-entered repayment, the first phase of the SAFE plan was implemented. So borrowers were enrolled, and if they were in that repay income-driven repayment plan, they were automatically placed in the SAFE plan because that plan no longer exists. And these borrowers are in that 0% administrative forbearance and no payments are due. However, this time period doesn't automatically qualify you for public service loan forgiveness qualifying payment months or payments towards that income-driven repayment forgiveness. These income-driven plans do have forgiveness attached to them after several years of payments, and under the SAVE plan, that's one of the items being contested in the court and in the litigation. So borrowers essentially should hang tight unless there's some reason they're really looking to switch out of that plan. Then they can complete an income-driven repayment plan application and potentially switch, or they can go to another student loan repayment plan that's not an income-driven plan, things like the standard 10-year plan. But typically, that's a more expensive monthly payment. So for the most part, we're telling borrowers to hold tight unless there's a case-by-case reason that they need to be switching to another plan. Borrowers who are not in a plan and have been considering income-driven repayment plans, it doesn't mean that the SAVE plan can't be applied for and you can't enroll in the SAVE plan. You can complete the applications, but we are hearing that's going to take months for those applications to be processed.
Elaine Rubin, who is the Advisor's Director of Corporate Communications. Thanks so much, Elaine, for joining and all the tips as well towards the end. Appreciate it.
Thank you.
Certainly. Coming up, are you browsing the web for cheap flights home these days for the holidays? We've got you covered. On the other side of this break, I'll talk to Hopper's lead economist who has 5 hacks to score the best travel deals this fall. Stay tuned. We're in the fall travel season. Millions of Americans are considering how they will spend the holidays this year. According to the latest data from Hopper, half of travelers plan to manage the cost of their trips by cutting back on other expenses. So we want to help you out and bring on the experts to discuss how to save money on your Thanksgiving, Christmas, and overall holiday travel. Here with more, we've got Haley Berg, who's the lead economist over at Hopper. Haley, great to have you here for us. A very festivus time of year. Let's dive into some of the money-saving hacks here, starting with the date that people should book their holiday travel by. What should I be marking off on my calendar?
You should be marking off October 14th. Mid-October is when we're going to see the best prices for airfare on both Thanksgiving and Christmas. And that's an important thing to note. Don't just book your Thanksgiving trips in October. You also need to book your Christmas trips. Prices for both holidays start to rise as soon as we get to Halloween.
I know Hopper has this feature, and I'm not sure how many other booking platforms or platforms as a whole have this feature, but trying to lock in a price if you're not ready to book, how can people kind of take advantage of that and make sure that they're spending within their budget as they're booking holiday travel?
Listen, we've all been there. We see a great price, but maybe our PTO hasn't been approved. We need to confirm with friends, family. You can use something like Hopper's Price Freeze tool. You pay a small fee when you see that flight that's at the right price, and you lock in the price where it is. You can book at that price at a later date. It gives you some breathing room so you can arrange your plans. And if the price increases, Hopper covers the price difference. If the price goes down, you pay the lower price.
And so one of the three things that we're kind of looking across, the hacks, they seem crucial here. Being flexible on your travel days. How flexible do people need to be, and what are the best days to travel when it comes to this time of year?
You can save about $200 per domestic airline ticket just by being flexible on the days that you travel for Thanksgiving and Christmas. Now, unfortunately, the cheapest days to fly are the holidays themselves: Thanksgiving Day, Christmas Eve, Christmas Day, and New Year's Eve. But if you don't have the flexibility to travel on the day of holiday, your best bet is skip that Saturday to Saturday, Sunday to Sunday trip, and try to fly Monday or Wednesday before Thanksgiving or Monday before Christmas Eve. So if you have some flexibility, it's a great way to save. If not, just avoid that Sunday return after Thanksgiving and avoid returning on the 27th or the 28th of December. Those are going to be the most expensive travel dates.
All right, oversold flights, crying babies, perhaps a furry friend that you might see somewhere going through TSA, cat or dog, who knows, hopefully one of those two. You also have hacks, though, ultimately about planning for disruptions. How important is that, and what type of cushion should people be putting into their overall travel experience?
When we survey travelers at Hopper, what we hear all the time is one of the biggest financial challenges to travel is actually unexpected disruptions. It's a hotel room they didn't expect. It's extra meals at the airport. Disruptions are a reality when you're flying, and they are worse during the holiday season. We recommend adding services like disruption assistance. It's offered on Hopper, other travel providers like Capital One Travel, Flair Airlines. If your flight's delayed or canceled, you can immediately rebook on the next available flight, regardless of the carrier, and we cover the cost. So you're not out of pocket. You just get onto your destination as quickly as possible. Add disruption assistance, build in a buffer day. If you're going to a wedding or a special holiday event, make sure you add a buffer day in just in case of disruptions.
Okay, I've heard of Small Business Saturday. I've heard of course, Black Friday. We've all heard of Cyber Monday, but what is Travel Day Tuesday? Like, is this new? It feels like we just keep coming up with new days. What is it, and how can consumers take advantage of it?
Travel Deal Tuesday is the Tuesday after Thanksgiving this year. It's Tuesday, December 3rd, and it's the best day of that post-Thanksgiving holiday season to get good deals on travel, on flights, hotels, rental cars, everything. We typically see, 8,000 routes on sale from airlines. We see hotel discounts. So if you don't book your Christmas travel now, or you're already starting to think about your 2025 travel, Travel Deal Tuesday is a good day to put in your calendar because you can get incredible deals on either those last minute holiday trips or maybe some warm weather destinations in early 2025.
All right, Travel Deal Tuesday. We'll combine it with Giving Tuesday. We'll cover the philanthropic and we'll cover the travel side as well. Haley Berg, lead economist over at Hopper. Haley, always a pleasure to grab some time.
Great to be with you, Brad.
Thanks. Guys, much more wealth after the break. You're watching Yahoo Finance. We're seeing a more cautious consumer shop this holiday season, even with retailers offering big discounts during their fall Prime Day sales. Shoppers, they are hesitant to swipe or tap their cards. According to a new CNET survey, nearly 3 in 4 holiday shoppers will make or have made a financial sacrifice to afford their purchases this season, and 30% intend to spend less than they did last year. For more on how to save big and maximize your holiday spending, I'm joined by Dacia Milden, who is the money editor over at CNET. All right, Dacia, just take us into first the consumer mindset going into this holiday and how many of the consumers out there are going to be looking for some of these big promotions or big doorbuster type deals.
Good morning. The majority of shoppers right now are planning on leaning on those early holiday sales. So when we start thinking about Prime Day sales literally launching tomorrow, Target, Walmart, Best Buy, you name it, the majority of shoppers are shopping early to try to take advantage of some of those savings. And they're still making sacrifices. A percentage are spending less on non-essentials such as travel and dining. People are setting smaller budgets even choosing to choose and go ahead and get fewer gifts. So when we start looking at that, it's very clear that the holidays are important and that they're willing to make some sacrifices in the meantime.
I mean, NRF had forecasted that retail sales would reach at least $5.23 trillion in 2024. As you think about the consumer going into this holiday season and what you've just laid out, I mean, it's clear they're going to be looking for deals, but is it also clear which retailer is best positioned to offer the best deals right now?
Well, it really depends on what you're looking for. So we've spoken with a few CNET shopping experts, and one thing is very clear, making sure that you are looking at the deals and comparing prices. What we're seeing is that for October, you're going to want to lean on batteries if you know you have those toys that you're going to need batteries for come December, even looking at those home appliances, vacuums, you name it. But when you start getting into tech such as laptops and even those video games, you're going to want to be very, very mindful and waiting until November. So compare prices is the best thing that I can say there. But more importantly, knowing what to buy and when to buy it is really important.
You know, it was interesting in the intro, we had mentioned some of the data coming from the survey, discussing the number of people and shoppers that are sacrificing other areas of their normal spends in order to make sure they can make some of the holiday purchases and perhaps spread some cheer as well. All of that considered, where does it sound like is the first area that's getting cut out of the budgeting, out of the spending?
Non-essentials, travel, dining, all of those fun experiences that we are really looking forward to even this fall. People are cutting them out just in order to afford the holidays. But that's also followed by, making those sacrifices when it comes to gifts and how they think about what they're buying and who they're buying for. So followed by, again, those smaller budgets, going back to maybe even buying fewer gifts, and more importantly, taking advantage of those sales.
Dacia, just lastly, while we have you, TikTok shopping. This is becoming, and just social media shopping more broadly. I mean, they're getting me. They got me for a couple dollars over the course of this year. I hope I'm not alone on that, but becoming increasingly popular and certainly this holiday season may be something that makes a lot of influencers some money and ultimately a lot of potential retailers some money as well. Where are we seeing this show up in people's feeds and be effective as well in either promotions or just being able to sell through inventory?
Yeah, when we start looking at just scrolling online, it's really easy. I guarantee you right now, you can hop on your Instagram and you'll start seeing some of those Amazon finds for Prime Day coming up tomorrow. That being said, it can be a really good deal, depending on what you look for, but it could also be a slippery slope. So I just want to advise, while it could be good to find that deal or find that really nice gadget, it can lead to a little bit of overspending and even debt. So just being mindful there. But in the same token, just like you, I'm finding some good finds myself and looking forward to seeing what, new gifts I can put under the tree this year.
Yeah, I wish a light box would pop up over my screen after I or am even considering a purchase to say, this is a slippery slope. Dacia said so. Dacia Milden, who is the CNET money editor. Thanks so much for taking the time here with us, Dacia.
Thank you for having me.
Certainly. Hey everyone, let's do a quick final check of the markets here as we're approaching the 12 noon hour here. Taking a look at the Dow, the S&P 500, and the Nasdaq. We are in negative territory across the board. 0.5% lower for the Dow, 0.3% lower for the S&P 500 and the Nasdaq. That's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned. Market Domination next coming your way at 3 p.m. Julie Hyman, Josh Lipton. I've seen them in the office, so they're definitely going to be here, bringing that your way. 3 p.m. Eastern Time. You don't want to miss it.